various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered, for me, the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, you know, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Go and Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior. And
this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it was a pretty extreme way to treat someone who had spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama Court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? This isn't a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinada is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. what's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And yeah, you've got to be ready for that. You've got to be ready for that if you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, you know, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place, the granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. You know, over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, you know, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory, and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commons is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, you know, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. You know, they didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his, you know, oil and gas pit was described to us as amongst the top 3. Amongst that, was very successful and made, you know, very large amounts of money as a young man. But, you know, inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commons decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, you know, drinking buddy's son, or they're his own kids' friends from football. You know, they're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, you know, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, you know, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. You know, not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, you know, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Faden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. You know, anyone that covers markets is going to be surprised about that. You know, you're thinking your BPs of the world or your Glencores, but there's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, you know, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And that whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. You know, they are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, you know, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally 2 people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You when it comes specifically to the topic of carbon offsets, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. We're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. We need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes! We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. And take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have vehicles moving and merging in and out of the network very much like a highway.
For now, though, HART's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects. And the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, And we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. You know, blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know
Mr. Force,
which is declining in value.
You don't have enough of it, right, to power the world.
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, 600. Today, 100, and we see it going down to 50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
how long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Well, the equity market is on the back foot at this hour after Fed officials continue to stress the need to keep raising interest rates to fight inflation, especially after today's economic news showed the economy is capable of handling more tightening. 2 p.m. on Wall Street from Bloomberg World Headquarters in New York, I'm Doug Krisner. So we had the readings earlier on second quarter core PCE and personal consumption. Both numbers were stronger than forecast. And on top of that, the figures on weekly jobless claims now at the lowest level since April. We heard today from the head of the St. Louis Fed, Jim Bullard, saying that additional Fed tightening is coming in the months ahead.
If you look at the dots, it does look like the committee is expecting a fair amount of additional moves this year. I think that was digested by markets and does seem to be the right interpretation.
So we have yields moving up across the curve, especially at the shorter end. The 2-year Treasury now at 4.19% with a gain of something greater than 5 basis points. The 10-year Treasury now with a yield of 3.75%. In the equity trade, we have the Dow down 2.3%, the S&P 500 weaker by more than 2.8%, and the NASDAQ composite is down about 3.7% today. Being very hard hit, shares in CarMax, the stock is down more than 23%. The used car retailer's sales and earnings missed estimates. Quarterly profit more than half of what the street was expecting. That's a failure. Explains why the stock is being so hard hit. The dollar is also being hit today with the Bloomberg Dollar Spot Index down about 0.2%. We're seeing a weaker yen, but a stronger euro at 97.79 U.S. cents. And the offshore Chinese currency stronger as well, with a gain against the greenback of around 0.9% at 7.1003. I'm Doug Krisner, and that is your Bloomberg Business Flash.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Businessweek with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
And a very good afternoon, everyone. Good, I guess, if you're short in the market. Live from the Bloomberg Interactive Broker Studio. Yes, we are streaming on YouTube. It is Thursday, Friday's Eve, September 29th, 2022. And Tim, remember when we talked with our TV colleagues about after yesterday's equity rally, what's going to be really key is if it continued today?
Well, guess what?
It didn't.
It didn't. It hasn't.
Yeah, and we continue to see stocks move to their lows of the session. We're going to talk about that. We're going to talk about the Fed drumbeat. We're going to get to that in just a moment. Speaking of the trade, hey, everyone, did you get the memo? Jay Powell needs investors to lose money until inflation comes down. That story in the new issue of Businessweek.
Well, it's working if you're long this market, so...
What?
People are losing money.
Oh, yeah, that's true.
And this week's cover story, it's about markets too, and on the U.S. dollar problem for the world and how the U.S. just doesn't care.
We don't care. All right. Plus the Porsche IPO charging out of the gate. And then we've got the former head of Disney International. He's now CEO of Pearson. He's going to talk about disruption in the educational publishing space. But we know you want to get to the markets. Let's get to the Market Drivers Report. Let's set the Business Week agenda on this Friday's Eve. Molly Smith, to my left, economics editor at Bloomberg News. We did have some economic data. She's in our interactive broker studio. And be still my beating heart. So too is Vince Signorella, global macro strategist at Bloomberg News. I thought he was like, I don't know, had become... I don't know.
This is the first time I've gotten to meet Vince in person, and I am so happy.
Become like an emoji, you know, because
I love it. It's so.
For a while. And here he is in the flesh.
Is it here? Are you here because the markets are hitting new lows for the year, or for the last 2 years?
My new boss invited me to lunch, so I thought it was a polite thing to come in.
It's all about the bosses. We all know that. Oh my God. All right. Let's get to it though. The equity trade rally yesterday. We all did say, man, let's see if it holds today. It has not.
Yeah, and I'm not surprised, to be honest. There was really no reason for it to hold. It wasn't a risk-on moment. It wasn't QE by the Bank of England. It was to stem a liquidity issue, which is their mandate to do also. For the UK yesterday, for the Bank of England, it was a matter of a temporary pause on fighting inflation for financial stability. And financial stability far more important than the inflation issue. The question going forward, and obviously traders are not expecting this to trip into the U.S. just yet. But the question forward is, will it? I think it's inevitable, and I think inevitably the Fed is going to have to back off.
Financial instability, you mean?
Something very, I won't say 2007, 2008, but we already just got news recently of a $3.9 billion LBO that was taken off the table because there weren't enough takers. There's going to be more of that, and we'll see how that plays into the Fed's hands down the road.
Well, the question that I have, Vince, is that priced in at this point? That uncertainty, that concern about the economy?
I don't think financial instability is.
No, I don't think so.
It's a different way of me asking, how much worse is this going to get, or could it get?
I think it's going to stay ugly until the Fed comes to the realization that they're pushing it a little too hard. I mean, Mester actually explicit came out about an hour ago, I think, and said, we're not backing off even if we go into a recession.
Who did? Loretta Mester.
Oh, Mester.
Which I think is an incredibly irresponsible thing for a Fed representative to say. I mean, I laugh at the point when they say there's going to be pain. I realize they're all in the 1% and they're not going to feel any pain, but I don't know who made it their mandate to force pain on the rest of the United States and the rest of the global economy.
Who'd have thought? Right?
Hold on, though. Just to push back a little bit, maybe those people, the people who are feeling the pain at higher prices everywhere. And that's a serious concern, is inflation.
Yeah, no, it definitely is. I mean, we saw a bad PCE print for the second quarter today, and that adds to that conversation. But I think if you look at the data over the last month or two, you see all of the data showing lower and slowing prices.
Yeah.
All right, but speaking of data, when it comes to the labor market, Molly, come on in on this. I mean, we saw another data point that reminds us, yep, it's still a strong labor market.
Right, with jobless claims this morning dropping down to below that 200,000 mark, which we rarely see in like the last decade. But reminding us, like you said, Carol, once again, that demand for labor is still very strong, and evidenced even more so what economists like to reference, seeing that continuing claims number. That those are the people who are repeatedly filing for unemployment claims, and that continues to hold very low.
What about the GDP data and so on that we got today? Vince referenced it.
Right, so that was really telling as well. These revisions were paint a very different picture of the economy than what we'd previously been under the assumption of. So what the revisions showed us was that growth last year in 2021 was a lot stronger than what had initially been reported, and that inflation was also running much hotter than what previously was thought. And then the data pointing to the first half of this year was a lot weaker. So perhaps already suggesting that there is maybe more credence to the idea that a recession is already underway. Granted, it's not so until that official arbiter says it is, and we're not going based off of just the 2 consecutive quarters of negative growth, but certainly makes it look a lot worse than what we thought it was.
The great and powerful Oz on inflation and the economy is going to come out.
Are you talking about the NBER?
No, I'm talking about behind the curtain. You know, the man. Whoa. Okay. Vince, well, so in terms of lows on equities, high on yields, are traders saying we're not even close?
I think on the high on yields, I think they feel like we're there.
Okay.
I think there's an interesting trade to be had in the short end of the curve in the 2s and 3s space, which have been pushed really hard because of the Fed raising rates. And even though you may have to be pretty patient on that one, especially if they expect to go again in November, there's a lot of room to run to the downside in those yields and upside in bonds. When the Fed says "whoa," as you like to say, "whoa,"
I believe it's "whoa."
And if you look at when the Fed raises rates aggressively, you can go back till Volcker time. In every single instance except for one, and it was because it was a response to fiscal policy, they've pushed us into a recession. So I would argue with anyone
it's not
that
easy.
This is
Can I
happen.
just say though, being a Fed official,
you
know this is not
Carol.
easy, and right?
I've spoken to some of them, and they contradict themselves enormously. It's really interesting.
30 seconds left, Molly. We have a very important data dump tomorrow when it comes to economic data. Tell us what to look for.
Right, so the first one of those being inflation-adjusted spending, and that's one of the biggest contributors to economic growth. So that'll be really telling, and I think some people are probably getting already a little bit freaked out looking at some earnings reports, especially from CarMax today, and what that seems to say about consumer strength already. And then the second one being the Michigan consumer sentiment and the inflation expectations that come with that. So far, they've been decently well anchored, but I mean, it doesn't really take much to get those out of check.
#WOA. I'm just going to say it. Vince Signorello, come back more. It was so great to have you here in studio. Always great to have Molly. You guys, great duo in terms of the setup on this Thursday.
Let's get to world and national news in Washington, D.C. with Nancy Lyons. Hey, Nance.
Thanks, Tim. Ian is not finished wreaking havoc on the southern Atlantic coastline. One of the strongest hurricanes to ever hit the U.S. has now been downgraded to a tropical storm. It's now over the Atlantic, but it could come ashore again near Charleston as a Category 1 hurricane. President Biden says he spoke with Florida Governor Ron DeSantis about the damage the storm has left behind there.
The numbers are still unclear, but we're hearing early reports of what may be substantial
loss of life.
More than 2.5 million Florida homes and businesses are still without power, and hundreds of homes were destroyed. Treasury Secretary Janet Yellen is fielding pressure from those who want her to weaken the minimum corporate tax and those who want her to hold fast.
Lobbyists are appealing to Yellen to weaken the 15% minimum levy on domestic corporations, while senators, including Elizabeth Warren, Angus King, Michael Bennet, and Don Beyer, wrote a letter obtained by Bloomberg News saying that she must stand firm against requests to, quote, dilute the regulations. The Treasury has yet to issue any guidance on the new law, although officials have said it is a priority. The levy, which was passed as part of the Inflation Reduction Act, takes effect in 2023. In Washington, I'm Amy Morris, Bloomberg Radio.
A government panel is apparently urging President Biden to declassify the U.S. intelligence report on the 2018 murder of Saudi journalist Jamal Khashoggi. That's according to the Wall Street Journal. The report determines Saudi Crown Prince Mohammed bin Salman ordered the operation that led to Khashoggi's death. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
All right, Nance, thank you so much. Nancy Lyons in her 99.1 newsroom in Washington. A lot of heavy stuff going, of course, the impact of the hurricane. It's a tough time, and I think about what Vince Signorella of our Bloomberg Squawk team said, Loretta Mester of the Fed saying recession won't stop the Fed from raising rates, and kind of Molly on her way out was saying, it's hard to hear that when you see the impact that the hurricane has had on people in Florida, and it ain't over yet, and just so many different things going on in our economy. And then one of the things we talk about, too, is when it comes to Fed policy, you're already seeing the impact on the housing market.
Yeah, screeching halt with what we've seen in terms of data, but at the same time, we know exactly why. Mortgage rates, they're at a 15-year high, and they're bringing fresh pain for home buyers. We're talking the average rate for a 30-year mortgage soaring to 6.7%. It's the highest since 2007, Carol, this according to a Freddie Mac survey of lenders showed today, jumping from 6.29% a week earlier, tracking a surge in bond yields after the Federal Reserve's latest rate hike and guidance of more increases to come. When we talk about mortgage rates, we're talking affordability just absolutely plummeting because the cost of that monthly interest payment goes up so much. Think about a year and a half ago, you get a 3% mortgage rate for a 30-year.
And you might be willing to pay up a higher rate if the value of your home is continuing to go up. And that's the double whammy. I mean, and keep in mind, that's 6.7. I mean, in some areas, mortgage brokers were quoting buyers 30-year rates above 7%, this week, according to interviews with loan officers and our own Bloomberg reporting finding out. That makes cost to finance a home purchase higher than many house hunters have ever seen. And then you combine that with near record prices and falling inflation-adjusted incomes. The last time the average 30-year rate crossed 7%, folks, you have to go way back, 2002. That's according to Freddie Mac. So it's a while.
You always like to point out, though, it's not as high as it was in the early 1980s. That was when the 30-year rate peaked at almost 19%, 1981. The median single-family house adjusted for inflation back then was just $209,000. Now, in August, it was close to $400,000 after falling from a record high in May.
That surge in rates, though, this year among the biggest 9-month increase in records dating back 5 decades, again, according to Freddie Mac. So it's one, again, quite a superlative.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The S&P 500 is at session lows right now with a loss of about 2.9%. We've had a number of Fed officials today stressing the need to keep raising rates to fight inflation, especially since the day's economic news argues that the economy can handle more tightening. The reading on second quarter core PCE and the reading on personal consumption, both of these numbers were stronger than forecast. And if you add into the mix the figure on first-time jobless claims dropping to the lowest level since April, everything points to tighter Fed policy. That was certainly the view today of Fed President Jim Bullard of St. Louis. And then we heard from the head of the Cleveland Fed, Loretta Mester. She's saying that she expects rates may need to go a little higher than a number of her colleagues are expecting. If you look at the bond market right now, at the short end of the curve, a 10-year, that's a 2-year Treasury at 4.18 with a gain of more than 5 basis points. A 10-year now at 3.76. We're up just about 4 basis points in yield on the long end. The Dow Industrial Average right now down 2.3%. Look at the NASDAQ Composite off about 3.8%. Apple shares down nearly 6% right now. This is after Bank of America warned of weak consumer demand. And shares in Jefferies also trading lower. Stock is off more than 2% after Jefferies Financial Group reported profit fell 52% in the last quarter. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, really appreciate that, Doug Krisner there. Well, the new issue of Bloomberg Businessweek is out, is on newsstands, online at Bloomberg.com/Businessweek, always, of course, on the Bloomberg terminal. And in it, a few stories about today's financial market environment. Tim and I teased it a little bit earlier. One is on the dollar, which we'll get into later. That's the cover story. But there's also another one on how Fed Chief Jay Powell knows he's inflicting pain on investors and how it's really needed to help get inflation down, Tim.
Yeah, the piece by Ed Harrison, senior markets editor for Bloomberg News. Ed, this afternoon joining us via Zoom from Washington, D.C. Ed, what I really like about this piece is it takes a historical look at what the Fed has done with interest rates or what it hasn't done with interest rates, especially since the financial crisis. Where are we right now on the Fed's path to raising rates and bringing inflation under control?
Yeah, it looks like I think we're at peak hawkishness right now, but we're getting back to where we were before the great financial crisis. That whole period between 2007 and 2022 was a 15-year period of what Larry Summers has been calling secular stagnation, where interest rates were well below where they could have been in other periods, mostly because inflation was low. But now that inflation has come back, we're going back to a much more normal environment. But we're almost at the end of this particular hiking cycle. I think we probably have 6 to 9 months at most.
You speak about this cycle and this environment. That includes, companies cutting workers. And just crossing the Bloomberg terminal, Meta announcing a hiring freeze, warning employees of a restructuring. And I'm looking at Meta's shares falling to session lows today. They've been under pressure, but now near their lows of the session. That means they're down about 4.3%. We'll have more on that news. By the way, Meta CEO Mark Zuckerberg announcing this freeze at a meeting with employees. He also says the moves are aimed at cutting costs and shifting priorities. And maybe no surprise as this company has even renamed itself, as we know, from Facebook to Meta. We're still talking with Ed Harrison, senior markets editor at Bloomberg News. There's a story, there's a line in your story, Ed, that says the Fed won't come out and say it, but when members of the Fed's Board of Governors see this reaction in terms of assets and the prices of assets coming down, they're probably pleased. I mean, this is what they need to see to happen to kind of rein everything in, correct?
100%, because, basically every Fed meeting that we saw in the last 3 or 4 meetings before the most recent one, we saw the markets go up when the Fed came out. So the Fed came out with relatively hawkish terminology, and then Jay Powell got talking, and people said, wait a minute, he's not as hawkish as we thought, and so stocks rallied. That makes the Fed's ability to tighten policy more difficult because they're working through the financial sector in order to have any impact on the real economy.
Ed, what happens on the other side of this when we do see the Fed pause rates or even start to cut rates at a certain point? When we do see inflation come down, how does that change what investors really should be prepared for?
It all depends on how late the Fed is in recognizing that inflation's coming down, and how sticky inflation is in terms of how much deceleration we get in the real economy by the time it goes there. I think that we're already seeing this deceleration. This thing about Meta, it shows you that it's starting to move out. We're seeing retail. We're seeing technology, we're seeing housing impacted, and soon, eventually, it's going to seep into the services sector as well. And at that point, it'll be too late for the Fed to make any differences. They'll have to be ahead of that. They'll have to know that their policy is acting with a lag. And I think that if they don't, the impact could be a lot more severe.
Hey, Ed, how much of this is, we all keep doing as a reference the 2008 financial crisis. Where we are today is not the same as where we were, 8. But, the Fed had to be watching, right, everybody's personal balance sheets as the market came undone. I certainly was watching mine. And cheap money, bringing rates down to nothing, certainly helped that out ultimately.
Yeah, that is an interesting question, because I think that the housing peak was probably 2005 in terms of actual prices and turnover. But then it wasn't until 2007 that we got the ructions in the financial markets. All of that's happening in a very compressed way, partially because the Fed is moving so aggressively relative to what they were doing in 2007. So I think Larry Summers said earlier today, it's like August 2007. Probably that's about right, that we're in the 2007 timeframe. So that means that if the Fed continues at the pace that it's going now, it's going to cause something to break, and then we'll quickly be into the 2008 period.
All right, we got to run. Hey, Ed Harrison, thank you so much. Such a relevant story. Senior Markets Editor at Bloomberg News, joining us via Zoom from Washington, D.C. All right, want to get back to that breaking news. A Bloomberg exclusive, Meta Platforms, the owner of Facebook and Instagram, saying it will freeze hiring and restructure some teams in an effort to cut costs and shift priorities. This is coming directly from the company's CEO, Mark Zuckerberg, announcing that in a meeting, in a Q&A session with employees, according to someone who was there. Shares of Meta now down about 4%. So let's get to it and let's get more.
Yeah, we bring in Bloomberg News executive editor Tom Giles, who joins us on the phone from San Francisco. Tom, what does our investing audience need to understand about what Meta Platforms is doing in terms of restructuring and freezing hiring?
Yeah. Thanks for having me on. So this is a meeting that's happening in real time. We're getting a read from folks in the room. What Mark Zuckerberg has said is that the macroeconomy remains tough and volatile. That's a quote. Meta is going to focus on a small number of high priority growth areas. This is really about them having to shift priorities and focus. They're going to be shrinking some teams. Other teams may get more resources. This is a big restructuring that Mark Zuckerberg is talking about. He told people in the meeting that we had thought that things would stabilize in the economy, but that's not happening. He is basically saying again, given the volatile macro economy, we need to make some hard choices.
Well, help us read into that, Tom, because this is also coming at a time when Meta Platforms is going through a huge shift in what it was. It's the biggest shift that the company's ever made. I mean, it lost $10 billion, invested $10 billion on its transition into the metaverse.
Yeah,
how much of this is specific to Meta Platforms versus the actual economy? I mean, because TikTok is, eating Facebook's lunch right now.
In his comments, we haven't heard him mention TikTok, but you're correct in that historically they have spoken about TikTok in the past as being a threat to them. They haven't used that word, but that's exactly what it is. Young people are spending more and more time on TikTok and less time on places like Facebook, the social network, or even to some degree Instagram. So social networks are all having to look over their shoulder, and every time they do, they see TikTok there gaining and gaining and gaining. That's the backdrop here. Again, that's not something that he talked about here, but you're right also that several months ago, Mark Zuckerberg said that we are going to double down on the metaverse. That's this idea, this new conception of what it will be like to be online, and It's going to be an immersive experience. It's going to be something where, they're looking to capitalize on that in a lot of ways, including AR headsets, VR headsets that will, let you kind of delve into the metaverse. The idea in the long term is that there could be a whole new way of interacting socially in the metaverse. There'll be a whole new, kind of paradigm for e-commerce, but that stuff is really down the road. In the short term, that's where you're seeing that's where you're seeing Facebook experience a lot of pain.
Right.
And, $10 billion is a lot of money to invest over the long haul.
Tom, it's really interesting that you say that. I feel like so many of the executives or investors that we have here on at Bloomberg, somehow we end up coming around to either crypto and or Meta and the metaverse. And we have the Pearson PLC CEO coming up, educational publishing. We're going to talk to him about that. Like, what's the impact of the metaverse on the educational publishing world? Is this just a case, and could it be 5 years from now, longer, shorter, perhaps, that this is a company that understands its market has changed dramatically, and they've got to start making the investments, hiring the right people to make sure that they are still around 5 years from now and that they're relevant. It's not different from the automakers, right, who've had to make some tremendous shifts as well, or are in the process of.
Yeah, exactly. Now, the fact of it remains that the metaverse is a very unproven concept. Car makers like Tesla have demonstrated that you can succeed at electric vehicles, and that there's a market for that. The risk that Meta is taking is that the metaverse isn't real, at least not yet. And will people, is this something that people want? Is this something that people have asked for? And we've experimented with versions of the metaverse in the past. Look at Second Life. It was hot for about 5 minutes, metaphorically speaking, and nothing. It's not anymore. There's a lot riding on this. Meta has a lot at stake in order to get this right. And so the reprioritization of their teams makes a lot of sense in light of that. And when you add on to the fact that we're not sure about how bad inflation is going to get, we're not sure about a recession or how deep it may get. You add those together, and you add the competitive pressure that they're feeling from TikTok. That's why Mark Zuckerberg is sharing this message with his staff at this moment.
All right, incredible stuff. And as we said, a Bloomberg exclusive. Tom Giles, thank you so much. Bloomberg News executive editor, joining us on the phone from San Francisco. Tom mentioned it's a live meeting. It's happening now. We're getting reports from someone in the room. The big headline, Meta announcing a hiring freeze, warning employees of restructuring. They did kind of hint at this very clearly over the summer. Here's some of the newest headlines. The Meta CEO are talking about focusing on a small number of high priority growth areas. Meta will end 2023 as, quote, somewhat smaller organization. And the Meta CEO telling its staff budget to be tight, quote, across all teams.
Well, let's get over to, as these headlines continue to come in, get over to Doug Krisner, who's keeping a close eye on these headlines and, of course, the markets.
Yeah, and Meta shares right now off about 3.6%, Tim. Year to date, this stock is down nearly 60%. Clearly a reflection of the slowdown that we're seeing in the market for ad sales online. So I guess you could say that Meta is being hit by the macro. A lot of weakness across the curve here in terms of equities, tech stocks being hard hit. Apple, another story that we're tracking. Shares are down nearly 6% right now. This is after Bank of America warned of weak consumer demand. And then on top of all of this, we've had a number of Fed officials today stressing the need to keep raising rates to battle inflation. We began by hearing from St. Louis Fed President Jim Bullard saying additional tightening is coming in the months ahead. And the head of the Cleveland Fed, Loretta Mester, was saying she's expecting rates may need to go a little higher than a number of her colleagues are expecting. Dow Industrial Average right now is off 2%. S&P 500 weaker by more than 2.5%. NASDAQ comp is off about 3.5% right now. In the bond market, rates up across the curve, particularly at the short end, where a 2-year Treasury is now yielding 4.18%, up a little more than 4 basis points. A 10-year now at 3.75%. And with that move down in rates, we've got a weaker dollar. Bloomberg Dollar Spot Index down 0.2%. I'm Doug Krisner. That's your Bloomberg Business Flash.
And again, just a reminder, thank you so much. Doug talked about it, but it is really our top business story at this hour. Meta Platforms, owner of Facebook and Instagram, saying it will freeze hiring and restructure some teams in an effort to cut costs and shift priorities. It's a live meeting going on. It is a Bloomberg exclusive, and we're going to continue to track some of the headlines coming out of that meeting. Stock's still down about 3.8%.
In the meantime, we haven't forgotten about the pandemic
and
also the consequences of the pandemic and what it said about the healthcare system and the safety net when it comes to healthcare here in the United States. For that, we have a great guest this afternoon. We have Dr. Daryl Gaskin, professor of health policy and management at the Johns Hopkins Bloomberg School of Public Health. Dr. Gaskin joining us this afternoon on the phone from Baltimore. The Bloomberg School of Public Health, it is supported by Michael R. Bloomberg, the founder of Bloomberg LP and Bloomberg Philanthropies. Dr. Gaskin, it's good to have you with us this afternoon. How are you?
I'm doing well. It's good to be on.
Well, can you talk a little bit about how we're thinking about the safety net when it comes to medical care in this country? For a large portion of the pandemic, we did see the federal government step in and provide assistance, especially as it did relate to the pandemic. But now, as the president has said the pandemic is over, there are concerns about how funding for that will continue. Where do you stand?
Well, one of the things that the pandemic revealed is that our current safety net is inadequate. When we saw those disparities in both infection rates and in deaths among minority populations, one of the reasons why we saw so many severe cases and people dying was because of the inadequacy of the safety net to sort of deal with the stress of the pandemic. So whether or not you got in an ICU that had a ventilator and had all the resources that were needed to handle the disease, really, in a real sense, determined whether you were able to survive COVID or whether you died from it. And there have been studies that have shown that once you control for where people went to get their care, some of the disparities we see, especially in mortality, that it went away. And it was really about where you got your care as opposed to sort of who was receiving the care.
You know, what's interesting, too, Dr. Gaskin, is, and just this week, our Bloomberg, Anna Edney, reporting on how private equity piled records amount of money into healthcare companies last year. I think Bain & Company put out a number that total healthcare investment more than doubled last year to $151 billion from $66 billion the year before. I think COVID kind of was like everybody reminding, oh, wait, healthcare, good investment. But her reporting also saying that it may not be good for patients, resulting in higher prices and the quality of care going down. You know, we already know this. The pandemic revealed it again, that there are already health disparities, as you were talking about, in our system that impact some communities more than other. So what reduces those gaps the most?
Well, I think one of the major problems is that while we have a lot of investment in healthcare, and while we spend close to 19% of our economy on healthcare, the allocation of resources is really not very well correlated with disease and the incidence of disease in our country. So the people who need the care the most are not often getting it, and then people who are receiving a lot of care often are probably receiving too much. You know, I've often said if we really want to get healthcare right in this country, we're going to have to learn how to say yes to some people who we've been saying no to, and say no to some people who we're saying yes to, because the marginal benefit of the care in which those persons are receiving is really not worth the cost that society is paying.
Who are those people, Dr. Gaskin?
That you say no to.
Well, I mean, it's sort of like, while for patients, for instance, sometimes people will advertise getting an MRI for you. You don't have any real symptoms, but they want to give you like a full body makeup of what's happening for you with regard to your health, to sort of give you some prognosis and assure you. Now, for the individual, that might feel very good to get that, but as a use of sort of an MRI for healthcare for the society, it's probably not the best use of it. It's a very costly machine to maintain. And so there are a lot of patients who are receiving care like that, sort of low-value care is the way in which we sort of term it in health services research. We're receiving these low-value care. It sort of makes us feel emotionally good, but in terms of sort of improving our overall health, it probably is not doing very much.
Does it worry you about the amount of investment money? We just talked about private equity money that's in healthcare.
No, but it does worry me with regard to, for instance, that there are patients who could use those services who are not able to access them. So one of the things that I often point out is that with Medicaid, what we do with Medicaid is we provide people with coverage, but then we pay the providers 50 cents on the dollar. And it would be just like if we took our food stamps program and we told the grocer that you're going to let poor people buy bread, but we're only going to pay you half the price for it. And so then what that means is that grocers are not going to really want to serve or provide services or provide a lot of services to poor people because they're just not able to meet their costs. And the same thing happens in healthcare, in that we essentially we cover our poor people, but we don't pay for them.
Yeah.
And as a result, in places where there are lots of poor people, you have inadequate services. So while we might be building stuff, we're just not building it all in the right places.
Hey, Dr. Gaskin, just very briefly before we go, what's the federal government's role in this?
Well, the federal government's got a major role because the federal government finances the Medicare program, and then also jointly finances the Medicaid program with the states, and so at some point, what we would hope is that the kinds of reimbursement that we see in the Medicare program, we'd also would see in the Medicaid program, and then that in some ways will allow the market to adjust. I mean, so when the patient who's covered by Medicaid walks into the physician office or walks in the hospital with the same sort of purchasing power as a patient with Medicare, then the market will adjust and will honor that patient. But as long as we allow this sort of discrimination, it's called price discrimination, the way economists call it, where you have some people with a lot of purchasing power and a whole bunch of people with not very much purchasing power, then you get this maldistribution of resources.
I think that certainly would resonate with the Bloomberg audience. We get that when you throw in that financial incentive or lack thereof. Dr. Daryl Gaskin, thank you so much. Professor of Health Policy and Management at Johns Hopkins Bloomberg School of Public Health, of course, supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies, on the phone from Baltimore. Want to get back to that Meta story.
Yeah, continuing on our coverage of Meta Platforms, the company announcing a hiring freeze and warning employees of restructuring. The story, a Bloomberg exclusive by Kurt Wagner, who joins us right now from the West Coast. Also with us is Bloomberg News, Bloomberg Surveillance co-host Paul Sweeney, who also knows a thing or two about TMT, who's spent some time in the space. Hey, Kurt, I want to start with you because
I think he was a banker, big-time banker, man. Martini
sorry,
lunches and all.
I didn't see big-time banker on the sheet that I have in front of me. I'm sorry, Paul.
Got to dig deeper in the bio.
Hey, Kurt, I want to start with you because you were, as Tom Giles was explaining to us just a few minutes ago, you were actually getting live updates from this Q&A that Mark Zuckerberg was giving, outlining this restructuring and hiring freeze. What's the latest?
Yeah, it's not good news, of course, if you're working at Meta right now, because it feels pretty widespread. Now, he didn't go so far as to say layoff, but he suggested that almost every team is going to have a budget reduction next year, and they're going to have to deal with that accordingly, right? And whether that means kind of letting attrition take its role and not filling jobs as they become vacant, whether that means kind of pushing employees from one team to another to kind of save some costs, or even weeding out poor performers. He was pretty blunt, like we need to do a better job of rewarding people who do good work, but also, moving on from people who aren't doing good work. And I think that's something that has never really had to happen at a company like Meta. They've always just had so much money and so much growth that I think people could kind of hide there. It sounds like that might be coming to an end.
Right. So maybe new for Meta, but I feel like in the corporate world, that happens all the time. Paul Sweeney, come in on this. You understand this space as well, like Kurt, and I feel like we did get a warning from Zuckerberg back in July. So what jumps out for you?
I think it's just the realization. I mean, they told us back in July that they were going to reduce their overall expense base by about $3 billion off of a, it could have been about a $95 billion expense base. So they were going to take it down a little bit, and that was in reflection of the slowing economy, the uncertain economy, I think, as Mr. Zuckerberg mentioned it. But you look at the revenue growth for this company, it's historically grown over the last 4, 5, 6 years. Its top line by maybe 20 to 30%, really strong growth. Consensus for this year, 12/31/2022 is flat, and only 10% growth next year. So that is a totally different environment than they've ever operated in since the beginning of the company, and they have to adjust their expense base.
Is this, Paul, a Facebook Meta story specifically, or is it actually a story about the macro economy?
I think it's a story about the macro economy. We've been hearing from a lot of tech companies, large and small, out of Silicon Valley, that they are cutting costs, reducing headcount, those types of things. So I think some of the original growth forecasts for a lot of these tech companies, they just can't deal with the headwinds from the global economy, not just here in the U.S. And so, again, this is an industry that has been adding headcount for a generation, literally, and they can't hire enough and they can't pay enough. But that's because top line was growing so quickly and they could, deal with the expenses.
Hey, Kurt, come on back in here. You too, like Paul, watching this company for a long time. And I do wonder, is it like, hey, kids, let's put on a show. Let's create the metaverse. And everybody's not buying in. I mean, Wall Street certainly hasn't been buying in this year. Or is it a case of, is that what's going on increasingly? Or is it a company that understands the market is changing and it's going to be painful for some time, and that hopefully, fingers crossed, everything crossed on the other side of this, there's a business that gets them back to some of those dynamic growth rates that Paul talked about?
I do think it's a little bit of both, right? I mean, they are not dumb. They've seen what's happened since Apple implemented the kind of new privacy changes with iOS and how that's really impacted their business. They've been banned in Russia. There's the war in Europe that's hurting their advertising revenue globally. There's just inflation. Like, there's all of these reasons for the business to be going poorly. But as you point out, they're still investing quite heavily in this very futuristic idea of the metaverse. And what I think I would imagine happened is Mark Zuckerberg is not willing to sacrifice that, right? I mean, this is his future of the entire company is what he sees as this metaverse thing. And so he says, listen, if we need to get leaner right now in order to keep funding that, that's a priority for him. Now, obviously, people who are losing their jobs or may lose their jobs are not going to be nearly as thrilled with that decision.
Right.
But that's why you have someone like Mark Zuckerberg with total control, because he can make those calls.
Paul, what I love about you is your background. You were out on the street. You were dealing with the media space as it continued to grow, change, evolve. Is there something akin to what's happening with Meta that we can think about way back when?
Well, I think the growth rates that we've seen with digital advertising, which have just been explosive, 30, 40% industry growth rates over the last 10 years, those are probably slowing down, moderating, as you would expect, the law of larger numbers. But what we're seeing right here, and it's not just from Facebook, it's also from Google as well, and some others, Pinterest and those types, digital advertising, like all advertising, is cyclical.
Mm-hmm.
And so the headwinds are coming in terms of the slowing global economy, and it's affecting all advertising, including digital, although the digital market share gain story is still very much in play.
What about Kurt Wagner, a company like TikTok?
Yeah.
Is it affecting TikTok?
It is. It's total, absolutely. TikTok is just an extraordinary growth engine. It's where all the kids are going, all the cool kids are going, and that's where the ad dollars go. And I think the
see
issue
at your
for,
desk. You're spending time
of course. So if you're Meta, that is a big competitor. But you take a look at the stocks. Meta stock is down 60% year to date. Apple's only down 20. Amazon and Microsoft are down 30, in line with the NASDAQ. So the market's definitely calling out Meta as something different.
I just want to point out Meta shares off their lows, but still down about 3.7% today.
Hey, Kurt, I want you to weigh in on the TikTok factor here, because you do mention that, of course, in your piece. How much of a backdrop is what's happening at Meta as a result of TikTok's success?
Yeah, I mean, they're pivoting the entire company to two things, which is the metaverse and what they call Reels, which is essentially their TikTok clone, right? So it's taking up time and energy and resources. They're seeing young people who used to kind of have Instagram had a good hold on, suddenly, going to a competitor. I think it's a real threat. It's a very, very real threat. And even if it's not dramatically cutting into their ad revenue at the moment, because I think TikTok's still sort of figuring that out, they're not dumb, and they know that this is going to happen at some point, right? So they're very aggressively fighting TikTok, and I think it'd be silly to say that doesn't have an impact here.
All right, just really though, very quickly, Paul, 20 seconds here. But going back to what I said, when American Align came out, did people question, or because we talked to Steve Case this week, is there some company where people were like, I don't know about this?
Yeah, no, I think the business is becoming much more competitive with TikTok, as Kurt was mentioning, and they're trying to pivot their company from a great business that everybody understands to metaverse at a time when your core business is coming under pressure. That's a tough act to pull off, and investors are really skeptical.
Doesn't seem like you're in the metaverse, Paul.
I'm not in the metaverse. When Tom Keene goes in the metaverse, I'll go in the metaverse.
I'll see you guys there.
We all will. All right, guys, we got to run. Paul Sweeney, of course, co-host of Bloomberg Surveillance and Bloomberg Markets on Bloomberg Radio. And our thanks, of course, to Kirk Wagner, Bloomberg News technology reporter, who's been following this as those headlines have been coming out of that meeting that Mark Zuckerberg has been holding with Meta employees.
All right, let's get over to Doug Krisner now, who's had a close eye on the markets. Hey there, Doug.
Hey, Tim. Looks like Meta shares are down about 3.8% today. Definitely the equity space on the back foot. We've had a number of Fed officials stressing the need to keep raising rates to fight inflation. The latest was the head of the Cleveland Fed, Loretta Mester. She said the Fed has to keep tightening to get prices under control. And she said that maybe rates need to go a little higher than a number of her colleagues are expecting. So it's about consumer discretionary, utility, information tech, all on the back foot, leading the S&P to a loss of about 2.6% right now. The Dow off 2%, and in the NASDAQ market, the composite index is down a little more than 3.5%. Look at Apple shares today, weaker by 5.7%. This morning, Bank of America warned of weak consumer demand. Also seeing shares in CarMax get very hard hit. The stock is down nearly 24% right now. This is after the company said that sales and earnings basically missed estimates. Quarterly profits were about half of what the street was looking for. We're seeing a move up in rates today across the curve. At the short end, a 2-year Treasury rising by nearly 4 basis points now at 4.17%. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, Doug, thank you for that update. Carol Massar, Tim Stenovic, live in our Bloomberg Interactive Brokers studio, streaming on YouTube here on Bloomberg Businessweek. Well, you know, the dollar, a problem for the world, and apparently the U.S. just doesn't care. Take that, everyone. This is the cover story of Bloomberg Businessweek, the new issue. It is out on newsstands, on the Bloomberg, and online. So let's get to it. And we've got a great reporter.
Yeah, we do. We got Liz McCormick joining us. She's bond and FX reporter for Bloomberg News. She's on the byline for this fantastic story. As Carol mentioned, it is on the cover of the new issue of Businessweek magazine. It's available on newsstands, on the Bloomberg terminal, and of course at bloomberg.com/businessweek. So Liz, let's just start with the basics here. We know the dollar is strong, especially against every other currency that's out there right now, pretty much. Why is that an issue for the rest of the world?
Well, think about it. The whole world has this major inflation problem, right? Of course, that's why the Fed is focused on tightening, and that's why we have such a strong dollar, among some other reasons. But all these other countries have this historic inflation as well, and their currencies weakening actually lifts inflation, because it, brings up import prices, and it's inflationary. So it's kind of the exact thing they don't want, So, in the old days, we'd have currency wars. Everyone wanted a stronger currency. Now people would like a weaker one, but everybody can't, currencies, there's pairs, right? So somebody's got to win, and the dollar's winning all over.
Well, and it's interesting too. You're right. I feel like the dollar is not just the financial markets, but it's such a geopolitical, I feel like, instrument, if you will. Jay Powell and the FOMC spend a lot of time. Do they, in terms of looking at the dollar and the impact? We talked, we had Loretta Mester earlier coming out, making a comment and saying basically, we got to keep on raising rates even in recession. Yeah. So you do wonder what that Fed is like, well, sorry guys, we got to keep doing this. We don't care what happens.
Yeah, exactly. I mean, I think it was the Fed's Bostic who, similar to Mester, was talking about, we have to stay the course on inflation. And we're aware of what's going on. The UK markets, if it reverberated, it could cause some weakness. But basically, we've got a job to do, right? Inflation is too high. We have to plow onward with raising rates. So, it was Stephen Roach I was talking to for this story. So you guys know him.
Yes.
And he said to me, yeah, Liz, it reminds me of Connolly. You know, these guys have been around for a long time. Former Treasury Secretary. And he famously said, listen, the dollar is our currency and your problem. And this is, you know, a super good case of that because, you know, the Fed is feeling bad because they were so far behind, right?
Right.
You know, kind of kept rates and stuff too low. And so I think they're like, listen, we just can't risk any more slip ups, right? So we got to keep tightening. But it is causing a lot of pain globally. And it might be good for U.S. travelers abroad, but otherwise than that, it's just kind of causing a lot of problems.
Liz, I do feel like we have a theme today because we talked earlier about that the Fed, you know, okay, if we're inflicting pain on investors in the public markets, financial markets, because that will help them in their inflation fight. And that's the same thing, right? A strong dollar could actually help them in their fight against inflation. Can you explain that?
Well, right, because a couple things. People usually say the U.S. is exporting inflation, right? But also think about U.S. companies. You were talking about Meta and all the companies. They all do a lot abroad. So in a sense, it slows the economy. It's a little bit of a headwind. These companies selling abroad, their products are a little more costly. So in general, it adds to what we know the Fed wants to tighten financial conditions, which can happen through higher rates, lower, wider credit spreads, lower equity valuations, and a stronger dollar. So it is one of the kind of, I call it's like a amalgam of things that are part of financial conditions, but a stronger dollar does do that. It's kind of a headwind to growth, and that's what the Fed's trying to do, right? Slow things down.
Yeah, I think we got the message, right?
The markets certainly have. So
right.
The question is, how much more tightening does there actually need to be to get inflation under control? What about from the perspective of developing economies and paying back debt and the effect that this has on the entire world?
Well, yeah, that's a real problem because, if your rates are higher, because part of some of these countries have had to step up the pace of their interest rate hikes, right, to try to keep up with the Fed. I mean, like we said, many of them have their own inflation problem, but have had to almost try to kind of keep up. So higher rates mean, and it's happening to the U.S. too, you're all paying back debt at a higher level. But if they have to pay back in dollars like you're getting to, it's harder to get that many dollars, right? So it's costing them more to pay if they have dollar-denominated debt. So it can go in various tentacles that hurt them, for sure.
Do we have to be worried, Liz, about, we've seen this in the past, right? You talk about history. Was it back in 85? In your story, you talk about the Plaza Accord. I mean, do we have to be worried, though, about other nations working in agreement together to counter that strong U.S. dollar?
Well, of course, some are trying in unison. Like you guys have talked many times about the Bank of Japan, which had came in and intervened kind of unilaterally, trying to slow the weakness in their currency. Other countries are doing some mild intervention, but not to be like the U.S. is everything, but for a major intervention to really have heft, the U.S. would have to be involved. So much of, FX trading, part of it is priced in dollars. So, I mean, other countries could try to coordinate a little bit more, but what it seems like, and never say never, but the kind of 1985 style Plaza Accord, it isn't in the cards now. We heard Brian Deese of the White House saying directly, I don't see that kind of thing, and Janet Yellen at Treasury, because Treasury is the folks who would intervene in the U.S. side, saying, hey, markets are working, things aren't disorderly. So, of course, we're always surprised at times, but so far they're not giving us any inklings that they, would do anything to counter the dollar.
Liz, help us understand just in the last 30 seconds that we have with you what this looks like going forward. And if any of the sources you spoke to, the currency traders and the economists, spelled out any sort of scenario where we could see the dollar actually weaken.
Well, it's funny, we have not to preview this, but we have this survey the Bloomberg folks do, MLive Pulse, and it's looking at that. And a lot of these survey respondents, at least for their part, are saying, we think the dollar is going to keep strengthening. They even see some risk. Maybe they know something I don't know, that there could be some coordinated intervention. But it just seems like, at least for the time being, the Fed has laid out, rates being, 125 basis points higher by the end of the year. So I think the dollar is going to stay strong.
Interesting times, as you so well know. Liz McCormick, thank you so much. Bond and FX reporter at Bloomberg News, a must-read here at Bloomberg, joining us via Zoom from New Jersey. This, by the way, the cover story of the new issue of Bloomberg Businessweek. Check it out. It is out. This is Bloomberg Radio.
close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close, but 60 minutes left in your trading session. Caroline Hyde, Romain Bostic, Taylor Riggs, joined now by our colleagues Karen Masser, Tim Stenovic, not wearing his hat right now, we understand, cowboy hat. But meanwhile, full Bloomberg cross-platform as ever, TV, radio, YouTube. Before we go into what's happening in the markets, we have got some breaking news, Romain.
Yeah, we're learning this about Apple, that their chief procurement officer, Tony Blevins, has actually been asked to leave the company. This after a crude remark that was made on a TikTok video. Is apparently a candid comment that offended a lot of folks here. We're now learning that Tony Blevins was actually approached by this Instagram creator. He made a crude comment, and now that has gotten back to Apple. Apple has now said that he will leave. Of course, we know that Apple has always been, particularly under Tim Cook, a big supply chain story. Basically, the way that they manage that. Tim Cook gets a lot of credit for that, but Tony Blevins, to a certain degree, was his right-hand man. I believe Mark Gurman is standing by right now with a little bit more on this story. And Mark, can you give us some insight into how you learned about the fact that Tony was being let go and who might potentially replace him?
Yeah, so Tony Blevins, as you said, one of the most senior people at Apple. He has been part of a 30-person or so group who reports either to CEO Tim Cook or COO Jeff Williams. Blevins has been the company's vice president of procurement. He's been at the company for about 22 years. in his role, he did pretty much every major supplier or partner negotiation, basically driving down costs of components like cellular modems, cameras. He worked on the deal with Globalstar to create the new satellite features for the iPhone 14 and iPhone 14 Pro. So this departure is a sizable void for the company. He has been integral to the company's success. He is known for his negotiation skills. This video has been discussed privately amongst Apple employees and Apple suppliers for the last few weeks, and today we learned that Blevins is leaving the company. This was a decision made by Williams, his boss, the COO of Apple, and Blevins' team, which was several hundred people, will now be reporting for the time being to Jeff Williams.
Hey, we're talking with Mark Gurman of Bloomberg. Hey, Mark, in shares of Apple, they're down about 6%, so near their lows of the session. Mark, you understand this company. You understand the players. You said he was really key, part of really the inside group. So what could be potentially the impact, the material impact on the company as a result of him leaving?
The material impact is he was known as a shrewd negotiator. He was known to have the ear of Apple suppliers and strike many deals. Instead, it will now be members of his team doing that. Apple has a few other vice presidents in their operations organization. Obviously, their COO, Jeff Williams, the buck stops with him when it comes to operations, as does with Sabi Khan, Apple's senior vice president of operations. So they're likely to take a larger role. There's an executive named Daniel Roskes at Apple, who is another vice president that works in procurement of components. He's likely to take a bigger role as well below Sabi Khan. So this is a bit of a gap for Apple. I want to get into, we spoke to Blevins, who said he wanted to take the opportunity to sincerely apologize to anyone who was offended by what he called a mistaken attempt at humor. We spoke to Apple as well, and the company said that he will be departing the company.
Mark Gurman, we thank you for on-the-spot analysis of your story, and indeed an extraordinary turn of events for Apple at the moment. We are still seeing Apple near the lows of the day, and in fact drags most of the tech stocks lower. We're seeing overall tech being in the line of fire today, the worst performing index, at least, off by 3.5% when you're looking at the NASDAQ. Big tech also, of course, falling as yields push higher. We're off by 3.5%. We see 2.7% lower on the S&P. We're off by 99 points. If we're looking at the Dow, off by more than 620 points, that's down by some 2%. Again, Russell 2000, your outperformer yesterday, your underperformer today, off by more than 3%, Taylor.
The story gets worse when you take a look at individual sector level. Energy, of course, is the, quote, best performer, but you're still off 0.7%. You migrate all the way back down to the bottom. Real estate, utilities, technology, of course, off anywhere from 3.25% to about 4% as well. And Romain, I point you down to the bottom. We've been focused on tech a lot, but discretionary as well. I know that we're pointing forward to not only Micron, but Nike quarterly results as well today. So discretionary off 4% on the day.
Well, a lot of that, of course, has to do with the fact that people took a look at those CarMax earnings this morning, and that caused a little bit of concern here because it doesn't appear to be just a CarMax story. This is much more of a macro issue. Of course, with interest rates rising, that means the cost to finance a new car or a used car will be higher as well. CarMax actually seeing that a lot of weakness in that business. Those shares down 24% here on the day. We also saw Rite Aid move a little bit lower on the back of its sort of lowering its outlook as well. So it's not just the discretionary items, but some of the staples as well. We're going to hit Nike earnings after the bell. And I just want to point out Lumen Technologies. We were talking a little bit earlier about Brightspeed pulling that LBO deal, basically the financing that they were looking for. It was a leveraged loan as well as a junk bond deal. They're putting that on hold for right now, saying that they will still come to market with it. But remember, this was going to be the spinoff, the combination coming out of Lumen Technologies. Lumen down about 6% and Meta Platforms down about 4% here on the day after we heard from Mark Zuckerberg saying the company will be smaller by the end of 2023.
Just want to say that LBO deal being put on hold, we talked with our Vince Signorella over at the Bloomberg Global Squawk Desk, and he said that's pretty significant. He expects there could be more deals, and it just talks about some of maybe the financial crisis that could be yet to come.
Financial conditions certainly tightening. That's largely to do with the Fed. Let's look at some volatility that is still managed to spike higher. Bank of America Securities has a GFSI market risk, basically an indicator that measures future price swings. It's all about the options market here. For our radio audience, it is basically showing that the risk of price swings is the highest since the pandemic. I don't need to tell you this, but particularly in the bond market having such swings, we see FX being so torrid, and indeed now stocks, the VIX starting to creep up. This is pretty self-evident, Carol.
Yeah, message received, and that's the latest that we're hearing from a lot of Fed speakers. Among them, Jim Bullard, the president of the St. Louis Fed, making some comments in a virtual forum earlier today. Check it out.
if you look at the dots, it does look like the committee is expecting a fair amount of additional moves this year. I think that was digested by markets and does seem to be the right interpretation.
And that's Jim Bullard, of course, president of the St. Louis Fed. But it is interesting, and we do feel like everybody's kind of a pig pile, Tim, if you will, when it comes to Fed speakers about, higher rates, everybody.
Well, let's look at what Cleveland Fed's Loretta Mester said earlier today about continuing to raise rates even if there is a recession. I mean, we're just getting hawkish Fed speaker after hawkish Fed speaker.
Yeah, that's pretty rough for people who are already maybe starting to struggle in our economy. Guys, a lot going on. We're going to be back in less than an hour's time. Our cross-platform coverage Beyond the Bell on radio, TV, and YouTube. We will count you down to the close on this very busy Thursday.
This is Bloomberg Businessweek with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, everybody. A lot going on. Tracking certainly that news out of Apple. We did talk about that stock is down about 5.7%, so just off its lows of the session. And then, of course, we had the news from Meta Platforms about job cuts and really just reconfiguring that company in terms of employees, in terms of growth expectations, and what's to come. Stock is also off its lows, but Tim's still down about 3.8%.
I'm still, and I'm going to beat this drum today, Carol, over and over again, because Meta is such a big and it's a lot smaller than it was earlier this year, but such a big and important company when it comes to online advertising. The question is this a story specific to Meta Platforms, or is this a story that also affects companies like Snap, Pinterest, TikTok, and more? We don't have a view into TikTok because it's a private company, but we, interestingly enough, did not see shares of Snap and Pinterest move lower when this news came out.
Well, and I thought it was smart, and I think you highlighted it too, what Paul Sweeney, co-host of Bloomberg Surveillance on Bloomberg Radio, saying that he thinks it's more of a macro story. It's not just Meta, and it has to do with that digital advertising space. They're not alone, right, in terms of some of the growth expectations. Meta may be thinking about the future. It's like, okay, so where does growth come from ultimately? But those pivots, they're not always a sure thing, and they can be uncomfortable while you're going through it.
A big part of this story, Carol, has to do with Apple and the changes that Apple made to its iOS operating system in the last couple of years.
You get it, don't you get it, when you're like, things come up and you're like, junk or
no thanks.
Yeah, exactly.
Thanks, but no thanks.
Yeah.
And what it does is it prevents companies like Meta Platforms and Facebook from being able to target ads as well as they used to.
Right, so exactly. So this is a company that's got to think about, okay, so where does growth come from? And so
they're saying the metaverse.
The metaverse, indeed. And Meta, right, pivoting to the metaverse and Reels and really trying to figure out. You brought up TikTok so many times. Everybody's watching the popularity, the usage.
I dare you to try not to get addicted to TikTok.
I'm not addicted.
I dare you to try not to. Do you have it?
No.
Yeah, exactly. Don't knock it till you try it.
Because I know if I start playing with it, I am a lost person. All right, folks, as we said, a very, very busy Thursday, and that includes world and national news, watching the hurricane, and so much more. On it all, Nancy Lyons in D.C.
Thanks, Carol. Florida is trying to recover following the wrath of Hurricane Ian. President Biden received a briefing at FEMA headquarters this afternoon and says there are early indications of a significant death toll, even though no formal numbers have been released. Bloomberg weather reporter Brian Sullivan has been following the storm and says water is often the major killer.
One of the problems is that we measure hurricanes by the Saffir-Simpson scale, which is anchored on the wind. So we're always thinking in terms of wind, wind, wind. But, it's that 20 inches of rain that the storm drops behind the coastline that kills people.
Bloomberg's Brian Sullivan reports Ian is now forecast to become a weak hurricane again and bring 7-foot storm surges to Charleston, South Carolina tomorrow. With the congressional election looming and just before a recess for campaigning, House leaders of both parties have staked their claims in today's weekly news conferences. Bloomberg's Irv Chapman reports.
Republican leaders Kevin McCarthy and Steve Scalise replayed their platform, focusing on inflation, crime, and the border.
The truth is, we simply cannot afford 2 more years of Democrat control. Families are struggling under the weight of big government socialism.
Democratic Caucus Chair Hakeem Jeffries.
We have an incredible track record of accomplishment. It's a choice between Democrats who are putting people over politics and extreme MAGA Republicans.
Jeffries said his caucus meeting focused on the resolution to finance the government past this week's deadline. In Washington, Irv Chapman, Bloomberg Radio.
That stopgap spending bill to finance the government has received a thumbs up from the Senate and now goes to the House. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. Watching a lot on this Thursday, including CarMax. Our TV colleague, Romaine Bostick, highlighting it in the trade today. It is down about 24%. This as the company has a huge earnings miss, which really sends a warning signal on the U.S. consumer. We constantly watch the U.S. consumer, so important to our global economy. And the strong labor market has made consumers feel pretty confident about spending, but this is also an indication of maybe more to come potentially.
Yeah, let's give some numbers here. So the fiscal second quarter numbers failed to meet Wall Street's expectations on pretty much every metric. In some commentary, the company said that the ability of potential buyers to afford vehicles has become a challenge, with rising interest rates and low consumer confidence adding further wrinkles. That part is a big deal. That commentary is really important there.
Yeah, and it dragged down other names. We saw Carvana down, Sonic Automotive, both of them down double digits in today's trade. One analyst in this story talking specifically about CarMax, reminding us that reminding Wall Street, I should say, that parts of the economy are already in recession. This is Ed Moya, a senior market analyst at Onanda Corporation. The, quote, affordability challenges highlighted by the company as the main reason for the big miss suggests it is only going to get worse as Fed tightening starts to impact the economy. I mean, this is a seller of cars who couldn't keep up during the pandemic, right? Every part, right?
Yeah.
Of the auto sector, right? And we still hear about, is it Ford that can't fill all the orders because they don't have all the components? And so to see weakness here, it makes you say, wait a minute, what's going on?
I think it was Keith Naughton, who we spoke to last week, Carol, who told us that Ford still has thousands of SUVs and trucks just sitting there waiting for the chips to come in. Hey, we're going to be continuing talking about autos in just a few minutes. Hannah Elliott is going to be joining us, and we're talking all about the Porsche IPO, which is actually a bright spot in the market today.
Yeah, over in Germany for sure. All right, we'll get to that in just a moment. You are listening and watching Bloomberg Businessweek on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We've got a sell-off in the equity market. That is the bad news if you're a long stock. So the good news, we are off session lows. Nonetheless, the S&P is down by about 88 points at the moment. Let's get you the latest on the price action. We'll cross to the Bloomberg Macro Squawk Desk to check in with Bill Maloney. Hi, Bill.
And good afternoon, Doug. That's right. U.S. stocks are plunging today, giving up yesterday's gains. Dow's down 529 points, and like you said, that's off session lows. S&P's dropped 88, while NASDAQ is down by 3.3%. The U.S. 10-year yield at 3.75%. Gold is little changed. Energy is in the red, and Bitcoin lower by 1.5%. Among the main 11 S&P sectors, all were trading in the red, led by losses in consumer discretionary and utilities. In the Dow, only Travelers was in the green. Boeing fell 7%. And led to the downside. In deal news, banks are said to shelve the $1.9 billion bond sale for the Brightspeed LBO. And in other news, Facebook announced a hiring freeze and warns employees of restructuring. Also, Apple fell 5.7%, helped by a Bank of America downgrade. And wrapping things up, Nike and Micron report after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Doug?
All right, Bill, thank you. If you've got the Bloomberg terminal and you want to get live audio updates on it, the function is SQUA, then, of course, the green go key. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, Doug, we are just having a conversation here in our newsroom. This is why we love it. This has been talked about for a while. It's now a reality. It's a big day for Porsche, the brand, the car, the company, now a publicly traded stock, as Porsche AG began trading in Germany over in Europe, the largest IPO in Europe in about a decade. The Porsche CEO talking earlier to Bloomberg outside the Frankfurt Stock Exchange about the outlook.
We don't expect a slowdown for Porsche in demand because of the recession effect. Because we are well positioned. We have a product portfolio for the next years, which is very, very stunning and emotional for our customers. And so we are looking very positive to the future.
All right, so the Porsche CEO there, no demand slowdown expected amid the recession. Very optimistic. A lot to get to, so let's get to it with one of our favorite people to speak to.
Yeah, we're with Hannah Elliott. She's auto columnist for Bloomberg Pursuit. She oftentimes is on the West Coast, but we're very lucky to have her grace our presence here in the Bloomberg Interactive Brokers studio about once a month, and today is one of those days. Hannah, what do you make of what we just heard from Porsche CEO Oliver Blume? The fact that essentially he says Porsche is recession-proof.
It's incredible. It's interesting that he chose to use that word because I just saw Bloomberg had another analysis story about Ferrari being recession-proof, and I'm already seeing how Porsche is trying to align themselves with Ferrari, which basically had, broke the mold when it went public, and every automaker tries to be like that. Porsche, Ollie, I heard him describe it earlier as a dream come true, because let's not forget, the Porsche family lost control of the company 13 years ago when VW bought them out. They are now back in control largely. Amid a market of really tough conditions. Everybody's saying this is a really tough market. It exceeded conditions. And going from Ferrari, now let's think about Aston Martin, that just had a terrible IPO several years ago. Porsche has to be so happy with this. It's kind of unbelievable.
It was like oversubscribed. People didn't even get to participate in it.
Absolutely.
High end of the range, right?
Exactly. And that's with a pretty complex structure, too. Let's not forget 75% of the shares are going to remain with Porsche, 12.5% were offered publicly, and 12.5% go to the family. And of the 12.5% that went publicly, 4 main investors include the Qatar Investment Authority, the Norway Sovereign Wealth Fund, T. Rowe Price, and ADQ. So those are big names there.
Yes. Did it really go public?
That's to your point about people being turned away.
It went to Norway and Qatar. That's where it went.
Big surprise. But talk about a $9.1 billion IPO, valued now at 75 billion euros. This is huge, and they, like Ollie said, I just keep going back to he's talking about this being a dream come true.
There was another quote, I think, that in terms of that Ollie Blume, the CEO of Porsche, talked to our Tom McKenzie, and he talked about autonomy. Now they are an autonomy company. We are separating those businesses very clearly. We won't have conflicts in between. I feel like my husband and I have been watching a show. It's about kind of the cars that made the world, and it's really fun to see like VW, right, Porsche, like the intermingled. Yes. It's been complicated. Yes. What does a private privately, or not a Porsche that's all on its own, what does it mean as a company, as a brand, and what does it mean for customers?
This means they can decide their own future. This means they don't have to answer as much to the overlords at VW. This means they can push toward the $6 billion of investment they've said to go all electric. A lot of the money that they raised is going to go toward electrification, which is very expensive. They've already said they're going to spend $6 billion on that. And this means, they can decide if they want to keep the 911 a combustion engine, which Ollie made sure to say they will keep that a combustion. If they want to keep that combustion, they can. They're not going to be forced necessarily to go electric with that.
Can these automakers that are just legendary when it comes to the way they've designed their vehicles and their engines as internal combustion engines, can they successfully transition to an electric future where maybe the motors are more of commodities than they are when they're actually based on gas?
That's a great question. We're going to find out. I mean, Porsche now is breaking new ground. We're going to find out. Now, Porsche has said, they've already said we will have a two-door electric car. That's the 718 Cayman that they've already said they will electrify. So they're pushing that way. We're going to find out. I mean, it's not been done before. This is really a brave new world in cars, and that's why it's so fun to cover. We're going to find out.
So what do you watch for now that they're, as you said, autonomy, what that means for them, and now that they're a public company over in Germany? And I do wonder, does it just mean it's just a matter of time before ADRs come trade over in the United States? I mean, I don't know if we know that. But I mean, what are you watching out to see from this company, Hannah?
I'm looking at product. I mean, I'm always looking at product. So I think it's great that their stock ticker is P911. That shows their heart is in the right place for car enthusiasts. I'm looking at product. As long as they still give us manual transmissions, as long as they give us internal combustion engines, yes, we love the electric things too, but I'm looking to see who are they catering to with the new product they come out with.
Pretty cool that in Europe you can have a stock ticker that has numbers in it.
I know.
You don't see that on the New York Stock Exchange or the NASDAQ.
Easy to remember. Like talking all around the newsroom. He just kept saying it over and over again. Thank you so much. So glad. And there's some great reporting by Hannah in the Bloomberg Businessweek magazine just out. It's in the Pursuit section about interesting collectors, their cars, and why they like them, and some great backstories as well. Hannah, thank you so much.
Guys, always a pleasure.
We love having you here on the
Can I
East
just
Coast
give a plug
West
for the
Coast.
weekend show? Because we hear from Hannah in the weekend show, too.
I just said that.
Oh, I didn't hear you say that.
Or did I not?
No, you said
no,
Business
I
Week.
didn't.
Yeah, you said Pursuits. Like the magazine has Hannah, our show this weekend has Hannah, so
You're going to be sick of me by the end of the weekend.
Never, never, never. Hannah Elliott, thank you so much. You are listening and watching Bloomberg Business Week. It's a magazine, it's a podcast, it's a radio show, it's everything. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Businessweek.
All right, one of the stories we've talked about for some time, I feel like, has to do with Chinese companies that trade here in the United States, Chinese listings on U.S. exchanges. We're going to get to a story that was among the most read on the Bloomberg earlier today.
First, though, let's get a market check. Doug Krisner is standing by. We got less than a half hour to go, Doug.
Yeah, we're near session lows, Tim. We've had a sell-off in the equity market. A couple of factors here, not the least of which Fed officials stressing the need to keep raising rates to battle inflation. We heard today from the head of the Cleveland Fed, Loretta Mester, saying rates may need to go above a level that her colleagues are expecting. Right now, I think that the last Fed forecast is looking for Fed funds to be around 4.4% by the end of the year. If you look at the two-year Treasury, we are up 3 basis points now at 4.16%. A lot of tech news today. Will begin with Meta Platforms, the parent of Facebook. The company has announced a hiring freeze, and apparently employees have been warned of a restructuring aimed at reducing cost and shifting priorities. Meta shares down 3.8% right now. And look at Apple being very hard hit today. It began with a Bank of America downgrade after B of A warned of weak consumer demand. And now we are hearing that Tony Blevins, Apple's VP of Procurement, will be leaving the company after making crude remarks on a TikTok video. Apple shares right now off about 5.3%. S&P 500 near session lows with a loss of 2.1%. NASDAQ comp off 3% right now, and the Dow Industrial Average is off more than 1.5%. I'm Doug Krisner, and that's your Bloomberg Business Flash.
All right, Doug Krisner, thank you so much. So a story earlier, among our most read on the Bloomberg, about the latest push by Chinese firms to avoid being delisted in the United States. Tim, it's really been an ongoing situation. I feel like there's been an ongoing conversation about it as well.
Yeah, and it's something that investors certainly need to know. I mean, what ends up happening if a company that you've invested in, the ADRs, for example, are no longer trading on U.S. exchanges? For that, we turn to Lydia Bayud, SEC reporter for Bloomberg News. Lydia joins us this afternoon on the phone from Washington, D.C. Lydia, great to have you with us this afternoon. So what have the firms done in order to try to appease U.S. regulators?
So there's a small handful of firms who are already making the switch to a U.S. or sort of other auditor that's outside of China or Hong Kong. And the idea is that if they can do that, they'll actually come into compliance with this 2020 law that otherwise, they risk being kicked off U.S. exchanges for if American inspectors, audit inspectors, aren't able to access these audit papers that are in Hong Kong and China.
Hey, Lydia, let's take a step back. Remind everybody about what the issue is. I mean, it really speaks to transparency, right? So, I mean, U.S. regulators are concerned about American investors really understanding or knowing what they're investing in when it comes to Chinese listed companies here in the U.S.
That's right. There was a whole regulator that was created in the wake of the Enron and WorldCom scandals about 20-some odd years ago to actually sort of inspect the auditors and make sure that their process for reviewing the financials of companies was on the up and up. And China and Hong Kong are the only jurisdictions left that haven't allowed U.S. audit inspectors in to do that. And so certainly American regulators kind of view it as like a pillar of accessing American capital markets, but you also have to allow this regulatory body in to sort of check the books, of your auditor and make sure that everything's accurate.
Hey, often we talk with our TV colleagues when we look at the markets. I often bring up the NASDAQ Golden Dragon Index, which reflects the Chinese names that trade here in the United States, or at least some of them. Give me some size and scope when we talk about Chinese firms that trade here in the U.S. How big a deal are they to the overall U.S. market?
Well, so, I'll speak specifically to this handful of firms that are making the switch to U.S. auditors. Many of them tend to be in the life sciences industry, so Beijing and Zai Lab are two of them who have switched to American auditors. And, they trade, their shares are between, I want to say, about like $35, $40 to maybe $150 or so, so not the hugest. But certainly they're not, tiny either. And at the same time, they are trying to find a way to make sure that they're not kicked off these exchanges. But then you have kind of the behemoths, right? The giants of China, like Alibaba, who are also under threat from this law. And so certainly, if someone has invested to get exposure to that market and these companies, it's a real risk right now.
Is there a risk to the actual exchanges here in the U.S.? I mean, I go back to this over and over again, Lydia. I worked from the floor of the New York Stock Exchange for 3 years, from, 2017 to 2020. And there was a point, it seemed weekly, that a new Chinese company would go public on the New York Stock Exchange. And I'm not talking about household names here. I'm talking about companies that we've literally never talked about as I've done this show, Carol.
Yeah.
I'm wondering that's important revenue for these exchanges. What does it mean for these businesses?
Sure. So I will just say there's no regulatory risk for the exchanges themselves. Obviously, there's the business risk, right? Like if you lose these tickers trading on your exchange, then you lose out with the revenues associated with that. But just to be clear, it's not as though the exchanges themselves are facing sort of regulatory risk.
How high on the priority list is this for the SEC and U.S. regulators?
It's been pretty high over the past year. The Congress sort of forced their hand when they enacted this law in 2020, and it requires a lot of efforts by the SEC and the Public Company Accounting Oversight Board, which is kind of one of those typical alphabet soup regulators, but that's the kind of auditing watchdog that's also involved. And they have spent the past 2 years or so hashing out this agreement, which they just reached in late August with China's regulators to allow access. Our colleagues in Asia had a great story out this morning or late last night on kind of that process itself being off to a rocky start, it seems. So, I saw major banks are still putting this at kind of like a coin flip, a 50-50 chance that things might not go well. They might, but we don't know. And we'll know at the end of the year when the SEC has to make its assessment.
Well, as we talk, the NASDAQ Golden Dragon China Index, it is down about 5% in today's session. Lydia Bayud, she is SEC reporter at Bloomberg News, joining us on the phone from Washington, D.C. I'm watching, Tim, the major markets. We've rounded out off our lows. We're seeing some buying here with still, about 20 minutes to go in today's session, but it really is tech that's really taking the biggest hit today.
Yeah, I got some pretty staggering numbers here. So Apple shares are down 5.1%. I mean, at one point, it was having its worst day since 2020, September of 2020. At one point, shedding hundreds of billions of dollars in market value when it came to U.S. tech stocks. Apple specifically, $140 billion getting shaved from its value at one point today.
Yeah, really broad-based, once again, in terms of today's trade and to the downside. If I look at the S&P 500, 43 names are actually holding on to some gains as we speak. 460 names are to the downside. NASDAQ 100, I think almost every name was down. Right now, 99 are down, 3 are higher. So it really is a negative risk-off trade in today's session.
Well, let's get to Washington, D.C. now for an update when it comes to world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. Rescue crews are wading through water and using boats to rescue Florida residents still stranded in the wake of Hurricane Ian. Florida Governor Ron DeSantis says it'll take a while for people to recover from what he's called a 500-year flood event.
We understand this is just the beginning. There's a lot more that's going to need to be done, and the state of Florida is going to be good partners with the folks here at the local level.
Governor DeSantis did talk with President Biden this morning to discuss next steps. FEMA Administrator Deanne Criswell will be traveling to Florida tomorrow to survey where support is most needed. Well, President Biden is being urged to declassify the U.S. intelligence report on Saudi journalist Jamal Khashoggi's murder, but he has yet to do so. We get more from Bloomberg's Nathan Hager.
According to the Wall Street Journal, a government panel has recommended the report be released to the public. The White House cleared the move in early 2011. This is the U.S. intelligence report that determined Saudi Crown Prince Mohammed bin Salman ordered the operation at the Turkish embassy that led to Khashoggi's death in 2018. It led to sanctions and travel bans bans for a number of Saudi security officials, but not on the Crown Prince himself. The White House National Security Council is not commenting on the panel's recommendations or why the administration has declined to follow them. In Washington, I'm Nathan Hager, Bloomberg Radio.
The families of 3 children who survived the Uvalde, Texas mass shooting have filed the first lawsuit tied to the massacre. They are casting blame for what happened on school personnel, local officials, firearms companies, and safety equipment manufacturers. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Massar, Tim Stenovic, live in our Bloomberg Interactive Brokers studio. And this story really started to break late yesterday, and it has been among the most read on the Bloomberg terminal. But we do want to bring up an update as we have been reporting out thanks to our Bloomberg team.
We're talking about the billionaire Mackenzie Scott, formerly was married to Jeff Bezos, has filed for divorce from her second husband. Dan Jewett, a science teacher she married following her 2019 split from Jeff Bezos. We learned this late yesterday thanks to a petition that was filed at King County Superior Court in Washington State on Monday that asked the court to dissolve their marriage.
Yeah, so filing this and the document that they did file a petition in Washington State on Monday, showing the couple have a contract spelling out how to divide real estate and other personal property. Quote, spousal support is not needed, it adds. I can only imagine the agreement before they got married. Is that safe to say?
Yeah, that's...
I'm guessing. I don't know for sure.
Yeah, there's a...
What's she worth?
She is worth $28.9 billion. That's according to the Bloomberg Billionaires Index. And remember, she announced her marriage to Jewett just last year. That was on her page for the Giving Pledge. The Giving Pledge, as you might remember, is a promise that the ultra-wealthy make that they'll give away the majority of their money in their lifetimes or in their wills. Jewett wrote a letter of his own, and the two were pictured together at the top of the page. Now only Scott's headshot and letter remain.
Well, if you remember yesterday, I don't know if you saw, like there was a story that came across and they said that his picture had been removed from their philanthropy website. I saw that cross first, and then it was later that it came out that they were, I guess, filing for divorce.
Yeah, the New York Times spotted this one early on. We should note that requests for comment to a Scott representative and Jewett were not immediately returned.
Yeah, I mean, we remember when the divorce came out, the breakup, and then what ultimately ended up in one of the richest people in the world, and certainly one of the richest women, $36 billion after her divorce from Jeff Bezos.
But she's sent out more than $12 billion since she signed the pledge in 2019, and she's given away money at an unprecedented pace.
Yeah, she's really been out there, and very quietly,
Yeah.
and to smaller organizations, and just a lot of organizations not even aware of it as it's happening.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We have a sell-off in the equity market. That's the bad news. The good news, I guess, if you're long stocks, is we are off session lows. The S&P had been down to a level around 36.10. We're trading at 36.39 as we make our way to the closing bell. We're down a little more than 2.1%. If you use the WEI function on the Bloomberg terminal, you can see it's clearly consumer discretionary stocks down, particularly the autos. Today, CarMax, this is the used car retailer, reported quarterly profit about half of what the street was expecting. Shares in CarMax right now down 25%. We also had a number of Fed officials stressing the need to keep raising rates. The head of the Cleveland Fed, Loretta Mester, was saying rates may need to go to a level a little above what her colleagues are expecting. The rate, or yield, I should say, on the 2-year now is 4.16. We're up about 3.5 basis points. S&P 500 down 2.2%. The Dow dropping 1.5%, and the NASDAQ comp weaker by about 3%. We have shares in Meta Platforms being heavily traded. Stock is off nearly 3.8% right now after Meta announced a hiring freeze. The company has warned employees of a restructuring aimed at cutting costs and shifting priorities. And Apple shares down more than 5%. This is after Bank of America today warned of weak consumer demand. I'm Doug Krisner. That's your Bloomberg Business Flash.
Thanks so much for that update, Doug Krisner. Really do appreciate it. It is 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg editorial board. Treasury securities play a crucial role in global finance, so it's troubling that the Treasury market has faltered several times over the past decade. The market's challenges stem from a fundamental imbalance. As deficit spending has driven up the U.S. government's debt, the value of publicly traded treasuries has ballooned, far outpacing the financial resources of the large dealer banks that are supposed to facilitate orderly trade in this market. As a result, the dealers are occasionally unable or unwilling to handle the volume of trades that investors want to make. Given that U.S. government debt isn't likely to shrink anytime soon, the best solution is to get more institutions involved. That would relieve pressure on dealers' balance sheets. As of now, most people have no reason to worry about the Treasury market. Let's keep it that way. This editorial was written by the Bloomberg editorial board. For more Bloomberg opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 10 minutes left, actually about 9 minutes left in today's trading session. You heard Doug working down the equity trade. We're definitely off our lows of the session. In fact, we've seen some buying in the last half hour or so, but still down 2.8% on the NASDAQ. We're down about 2% on the S&P 500, and we have seen yields come off some of those higher levels. I'm just doing a quick check. That 10-year note with a yield of 3.75, shorter end of the yield curve, that 2-year at 4.16, so well above that 4%. So delighted to have with us Luca Paolini. He is Chief Strategist at Pictet Asset Management, and usually he's on the phone, but he's in our studio.
It's really good to have you here with us this afternoon, Luca. How are you?
I'm not too bad. I'm great to be here after so many months, and it's still not back to normal, but it's great to be here.
Well, something that is not normal are these markets.
Well, that's for sure.
Yeah, help us understand what's going on here. I mean, we saw quite the rally yesterday, but a sell-off that's really taken away all the gains of yesterday.
Well, I think the simple story is, let's keep it simple.
Yeah.
We have very weak growth and very high interest rates, which is exactly the opposite of what we are seeing actually 2 years ago. This is why global stocks are at the same level of the end of 2019. So we have this COVID bubble, if you want, and now we're back to normal. When interest rates are being normalized, earnings are being downgraded. So it's, I think what was in a way strange, abnormal was, but I think the rally that we have seen during the pandemic. And now we're back to a more normal, let's say, less favorable environment.
You're someone who has seen market cycles, reported on it, written about it. So does this market cycle, is there anything that you feel like we can draw on history that can help us understand maybe how this plays out ultimately?
Well, I know it's very fashionable to look at what happened in the 70s, right? Higher inflation, stagflation. I think the situation is very different. In the 70s, trend growth was much higher than now. So now we have much higher debt. Trend growth is lower. We are all older. On average, I think we are 10 years older than in the 60s or the 70s. So I don't like this comparison with the 70s. It's completely different. But also we haven't seen, it's difficult to compare this cycle with the previous cycle because inflation is so high and interest rates, we tend to forget that. You know, look at the US, but even the UK, interest rates are well below the rate of inflation. So the idea there is a lot of monetary tightening, but I mean, we haven't seen it really yet. And so
do you think inflation comes down to where rates are, or rates have to go up to where inflation is today?
I think both. I really believe that inflation, especially in the U.S., has peaked. You look at the strength of the dollar, we keep inflation in check.
Yeah, we talked
Oil
about
prices have been falling. Supply chain have been easing. Retail sales in real terms are the same of 1 year ago. So I can see inflation falling. The question, though, is that there's probably not going to fall fast enough for central banks to stop the tightening cycle. And so this is why investors are nervous, because we have higher rates, weaker growth, which is exactly the opposite of what we have seen during COVID. And this is the market reaction.
Does it make sense, the weaker growth against that strong labor market? We got weekly jobless again here in the United States, and they came in lower than forecast. A reminder that, man, that labor market still continues to be really strong.
I have to admit that I'm very surprised by the resilience, actually the strength of the labor market in the U.S.
I think the Fed is, too.
All of us, right?
Well,
and the Fed is probably saying, thank God, because I can continue.
Yeah, look, it's good news, right? It's good news. I want to say it's bad news when everybody has a job. The reality, though, is that this is a situation where it's difficult for the Fed to sound less hawkish when they're saying, look, we need to have the labor market back to normal, and on a weekly basis we see basically jobless claims falling. And I don't think it's just kind of a strange data. This has been a trend that's been going on for some time. I'm very surprised, I have to say, by this.
I am too, but we are getting this anecdotal, and the jobs reports that we get each month are backward-looking, and we really are seeing anecdotal evidence of this play out, especially in Silicon Valley. I mean, look at the Meta Platforms news, the company formerly known as Facebook, that we got earlier today, announcing a hiring freeze and warning employees of restructuring. So the company essentially saying, we're not going to backfill positions, we're not going to lay people off yet. When does that start to show up in the data?
And I think I agree. This is the kind of the concern that I have. We say the consumer is resilient because the labor market is resilient, but the labor market is, as we all know, the most lagging indicator of all. And of course, there has been, if you think about a secular trend for labor market to be tighter for a number of reasons. So I wouldn't say I'm more optimistic about the U.S. economy because the labor market is stronger. I would say this is a lagging indicator. We have to take.
But weekly jobless are pretty current data, right? It lags by a week. I mean, that's...
Yes, but it is true. But the nature of the labor market is to be lagging because companies, before they make a decision to hire, it's not something that you take every day. So it's just structural. But I agree that it sounds strange, but I have to say that in previous cycle, we have seen the labor market being basically the last thing to drop. So I think for me, the most important thing is to see actually what companies are doing. Is about investment. We tend to be overly kind of concerned about consumption, but investment is almost as important. And this is where I'm worried because with earnings being under pressure, margin under pressure, investment will come under pressure. And with investment under pressure, the labor market will probably follow.
Well, I think it was Romain Bostic who talked about the number of stocks that, we've seen hitting lows. I'm looking at JP Morgan Chase. Earnings are going to come out on October 14th. It'll be a big one in the morning. That stock hitting a 52-week low today. And I'm curious to see what Jamie Dimon has to say. Add all this up. You've got to help your clients. You've got to help them figure out how to make money in this environment. On our planning call, our team, our producer, Paul, shared with us that you like, in particular, I think, is it UK and Japan? Or
and
Europe
I said,
Japan?
Yeah.
And we did. We were like,
in terms of equities, we have been reducing our weightings into the UK. But, we tend to forget that the UK market is basically global. So 80% of UK stocks have their sales abroad. So a weaker pound actually helped them. That's why the UK market is doing well. Japan is a different story because it's cheap, no policy tightening, no inflation risk, and actually an economy that is quite resilient. I think, though, the main message for us is to reallocate into bonds, especially in the US. We think that the peak in bond yields is very close, and we think investors should consider bonds again after an horrendous basically.
Was it Jeffrey Gundlach who talked about that too?
Yesterday.
That looking at the bond market
2 days ago,
right, and finding it interesting. So you do think we peaked in terms of yields?
Yeah, we are very close. We have 4%, so we are not too far away from that.
All right, we got to run. Thank you so much, and great to have
Thank
you here.
Thank you for having
Still
me.
not normal, but yeah, that doesn't surprise me.
Maybe next time I come here.
Fingers crossed.
Fingers crossed, yeah. I was just going to say that, Carol.
Luca Paolini, thank you so much. Chief Strategist at Pictet Asset Management. Great to have him here in our Interactive Brokers studio. All right, folks, we just have a few minutes left in today's trading session. Watching that equity trade, we've bounced off our lows, but we are broad-based selling nonetheless, and those major equity averages, in particular tech, it is down on this Thursday. Time to head over to our TV colleagues, our cross-platform coverage, radio, TV, YouTube. We're going to count you down to the close on this Thursday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell, and here to help take us beyond the bell. We're joined right now by Carol Massar and Tim Stenovic, and welcome our audiences across Bloomberg Television, Bloomberg Radio, as well as on YouTube. And S&P 500 at 3641. It already hit a fresh intraday low at one point on the day. Looks like we're going to hit a new closing low as well.
Yeah, we are bouncing off, though, our worst levels of the session when it comes to the S&P and the NASDAQ for sure. But it was interesting. I was just checking out the NASDAQ 100. I mean, so broad-based selling. All of the tech names, almost every name in that index is down today, about 99 or lower. Three are actually holding on to some gains, but it's just a reminder of how tech is really getting killed today, Tim.
We just had a great conversation with Luca Paolini, the chief strategist at Pictet Asset Management. He said what we're seeing right now is a return to what we saw pre-pandemic, the idea of weak growth and higher interest rates. It's a more normal, less favorable environment. He did have some optimism, though, said that inflation in the U.S. has peaked. He pointed to oil prices falling, commodity prices coming down, but not fast enough for central banks to actually pause the tightening cycle.
We've been having some really interesting conversations here about some of the stresses, and I don't want to highlight panic or mass illiquidity, Caroline, but we've been hearing a little bit in the Treasury market, some stress, a little bit in the LBO market, as we've been mentioning some of those credit deals. So it's not showing up in just that broad gauge of high yield spreads, but you've been looking underneath the surface as well. There are pockets of some small stresses in this market.
Yeah, a few dislocations, but this is what financial conditions getting tighter looks like. This is arguably what the Federal Reserve has to push through.
Yeah, well, you talk to some of the banks that are now sitting on $4 billion in debt from that Brightspeed deal. We saw Tellurian pull its, and of course, all the drama surrounding Citrix here. So some stress is out there, at least for some individual names. As far as the broad market stress, you're looking at a Dow Jones Industrial Average that's going to finish the day lower by about 1.5%. Meanwhile, the S&P 500 is down about 78 points, a little bit more than 2%, and the NASDAQ Composite going to finish the day down by about 2.8%. The Russell 2000 lower by 2.3.
You know, as you guys talk about financial conditions and stress, maybe you want to take a look at the banks, and the banks were down about 1.6%. So, Taylor, doing a little bit better than what we saw in terms of the trade for the S&P 500 and the NASDAQ today.
Carol, it is you and me against the world, because Romaine tells me this, I quote, broad-based sell-off too much, but I'm going to take my cues from you, because take a look at this sort of underneath the surface, take a look at even, quote, the best performers, and it is still all red on the screen. So when you see sort of this massive selling and the broad-based selling that is under pressure, this is a good way to show that. Energy was the best performer, but it's still off about 0.1%. Finally, we'll just go to some of the worst performers on the day. Pretty unreal when you think about real estate, utilities, those were off anywhere from 3 to 4%, really the rate-sensitive parts of this market. Technology as well, and some of those auto and component index, you're off 4 to even 7% on the day.
All right, can we really trust somebody who wears Crocs? I'm just going to put that out there.
Thank
for
you,
Romaine.
Carol.
You're very welcome.
What did I miss? Who's talking Crocs?
We blondes got to stick together. All right, let's get to DXC Technology. It's one of the gainers in today's session. It was up as much as 12.6%, finishing the day with about a 2.5% gain. Top in the S&P 500, trading halting earlier today. Stock jumping on report of a $45 per share takeover offer. I should point out that earlier this month, Bloomberg News did report that this company was working with advisors after receiving takeover interest. So that we were keeping an eye on. Occidental Petroleum, also a gainer, up more than 1% in today's session, top in the S&P 500. Did you see the news late yesterday? Berkshire Hathaway buying nearly 6 million shares between September 26th and September 28th. And, Romaine, they now have about 21% of the oil producer.
Yeah, a lot of people are focused trying to figure out exactly what they're trying to do there, whether there's a takeover in store or not. Meanwhile, we do want to turn back to some earnings. Micron, the chip maker, crossing the wire right now. Shares down about 6% here in after-hours trading. The headline number here on their fiscal 4Q numbers, 145. That's a beat versus 137, which is what the street was looking for. The cash flow from operations pretty much coming in relatively in line at about $3.78 billion. Here's your forecast going forward here for the fiscal first quarter adjusted revenue. They're looking at guidance of $4 to $4.5 billion. $4 to $4.5 billion. The street on average was looking for $6 billion. That's a huge miss here for Micron, even on the back of the fact that they'd actually warned back in August that sales might be slowing.
We just want to mention, Caroline and I both saw this, and our ears perked up immediately. We're hearing from the CEO saying that we're taking decisive steps to reduce our supply growth, including a nearly 50% wafer fab equipment CapEx cut versus last year. We're expecting to emerge from this down cycle more well-positioned to capitalize on that long-term demand for memory and storage. So a little bit of a CapEx cut relative to last year.
And this is where the pain is clear, because Sanjay Mehrotra, when we spoke to him previously earlier this year, he said, look, we are done with the boom-bust cycles. So many chip executives have wanted to tell us that it's a new era in some way, but clearly we have got a stage where we have too much supply in the market.
The company CEO, as you mentioned, saying we expect to emerge from this down cycle well-positioned, but how long is this down cycle going to last? And at this point, where are we in the down cycle?
That's the big question here. Just want to hit you a couple other numbers here. The company now projecting a fiscal first quarter loss. That's on an adjusted basis of about 6 cents a share. The range is 6 cents to 14 cents a share. So a loss of 6 cents to profit of 14 cents. That's the range that they're giving here for the fiscal first quarter. The street was looking for profit of 87 cents. So no matter whether they hit the top end of that range or the bottom end of that range, it's well below what the street had priced into this stock. The company also saying that their gross margin in the most recent quarter held at about 40%, but they expect it to slip to 24 to 28% in the first quarter.
All right, let's just remind everybody, especially for those folks on radio, that the stock is down about 2%, but off its lows post that earnings news. And this takes me back to some of the news that we've gotten and some concerns about Apple, maybe, reining in some of their production plans. Keep in mind that Micron Technology, Apple's a customer and a big one, and so it all is connected, and that's why when someone like Apple makes some news, you have to think about the whole supply chain.
Yeah, and thinking about the broader conversation when it comes to chips, the SOX, this Philadelphia Semiconductor Index, has been getting hammered lately. Just this week hitting another 52-week low and indeed falling to levels last seen in more than a year ago. So the concern is, of course, weakening demand for all parts of the chip industry. At the same time, though, you still hear from, companies like Ford that are waiting for certain types of chips. So the story is pretty complicated.
And I just want to point out, too, just to Carol's point about the supply, we do know Apple is obviously a big customer of theirs. But, of course, it's also really just a lot of those computer makers, the Dells and the Lenovo's of the world. Yep. And remember, everybody was buying computers during the pandemic because they needed them to work from home. And I wonder if that's now weighing on this company in a way that maybe they hadn't telegraphed before.
Well, and RBI...
Oh, no, I'm sorry, go.
RBI analysts had certainly forecast that, saying that they were looking for some memory weakness, particularly within the PC market, as well as consumers were either tapped out or pausing on some of the inflationary environments as well when you think about demand for these products. I don't want to make too much of this, but it is interesting that in the midst of a 50% cut in that CapEx, Caroline, they're touting the strong balance sheet and the record $2.9 billion in terms of return to shareholders. So really sort of tiptoeing that line between returning cash to shareholders versus maybe cutting back on some of that CapEx.
Interesting as to whether they know anything about the dollar, and the earnings call a little bit later. This is a global company, of course, that actually produces abroad as well, and so how much that actually ends up benefiting to a certain degree. But really, this is a company that's torn by wanting to pivot into new areas of growth, new areas of needing to see memory, saying this was just a step change that would weather any sort of down cycle, but clearly they are at the behest of the overall microeconomic and macroeconomic environment.
Yeah, and I'm glad you went there, and I want to go back to what Romain said. I mean, this is where we have to figure out, is this a result of, again, the economy continuing to shift coming out of the pandemic, right? And different players that won big time that are not anymore. It's an adjustment. And how much has to do with the bigger, broader macroeconomic environment of growth slowing down? And this is the tricky part for companies and for us and we as investors, everybody as investors, to try to figure out what the real story is.
Yeah, and I mean, look, and you have to put this in the context, too, of all the warnings that we've gotten from companies saying that they're either scaling back, trying to control their costs, or in some cases being a little bit more proactive and just throwing a lot of people out the door. We talked a lot about Meta Platforms a little bit earlier in the day on the back of that Q&A with Mark Zuckerberg, the idea that they are planning to basically to be a smaller company. And I was just looking at some of the data at the closing bell here. This is the first time in quite some time that Meta has actually not been in the top 10 largest companies in the S&P 500 based on market cap, actually falling out of the top 10 today on an official basis. Exxon moving up a little bit here, so a little bit of a changing of the guard as people position for, I guess, for what they think, at least in the now, is a better deal.
You know, back to Micron just for 1 second here. You know, looking through this release makes me think of a comment that Caroline made early on in our broadcast today about this is actually what the Fed wants to see, the idea of financial conditions tightening. When you raise interest rates, you do see a pullback on CapEx because, you know, it gets more expensive to do these things. We are seeing financial conditions tightening, and it's happening in real time.
What's interesting, though, is whether analysts start to keep up. You know, we're about to embark on a new earnings season. Yeah. We still got 29 buys on a Micron, only 2 sells. The price targets are still well above where the price actually is at the moment. When are we going to see that sort of capitulation coming from the street?
Yeah, exactly. And let's not forget, we've got Nike earnings, so we're going to get a good reading shortly on the consumer base. That stock, like so many, hitting 52-week lows again in the trade. All right, guys, we got to wrap. We got to wrap it up here on radio, TV, and YouTube. It's been a busy Thursday. We will be back again, same time, same place tomorrow.
You're listening to Bloomberg Businessweek with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening and watching Bloomberg Businessweek on radio, on YouTube. Carol Massar along with Tim Stenovic, and again, Micron watching it in the after hours. The big thing is what it had to say about the first quarter adjusted revenue, the outlook, $4 to $4.5 billion. That is big difference from the estimate that's out there of more than $6 billion.
Yeah, worth repeating the commentary from the company's CEO. The company said they're taking decisive steps to reduce our supply growth, including a nearly 50% wafer fab equipment CapEx cut versus last year, and expect to emerge from this down cycle well-positioned to capitalize on the long-term demand for memory and storage.
So, data dependent, watching the economy and adjusting as we go. It sounds like that from Micron. All right, let's get back to world and national news. Nancy Lyons, she is in D.C. Hey, Nance.
Thanks, Carol. Ian is not finished wreaking havoc on the southern Atlantic coastline. One of the strongest hurricanes to ever hit the U.S. has now been downgraded to a tropical storm, and it's over the Atlantic. But it could come ashore again near Charleston as a Category 1 hurricane. President Biden says he spoke today with Florida Governor Ron DeSantis about the damage the storm has left behind there.
The numbers are still unclear, but we're hearing early reports of what may be substantial loss of life.
More than 2.5 million Florida homes and businesses are without power. Hundreds of homes were destroyed. A short-term spending bill to keep the government running through December 16th has made it through the Senate. It now must be approved by the House in order to avoid a shutdown when the current fiscal year ends at midnight tomorrow. It also includes additional military and economic aid for Ukraine. Treasury Secretary Janet Yellen is feeling pressure from those who want her to weaken the minimum corporate tax and those who want her to hold fast. We get more from Bloomberg's Amy Morris.
Lobbyists are appealing to Yellen to weaken the 15% minimum levy on domestic corporations, while senators, including Elizabeth Warren, Angus King, Michael Bennet, and Don Beyer, wrote a letter obtained by Bloomberg News saying that she must stand firm against requests to, quote, dilute the regulations. The Treasury has yet to issue any guidance on the new law, although officials have said it is a priority. The levy, which was passed as part of the Inflation Reduction Act, takes effect in 2023. In Washington, I'm Amy Morris, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons in our D.C. newsroom and bureau. Of course, we talked about Micron earnings. We're awaiting Nike. We'll break them as soon as they cross the Bloomberg terminal. In the meantime, another story that came to our attention.
Yeah, this one of particular interest to people in New York City. New York City cementing a decision to use a controversial academic screen for many of the city's schools. Remember, they were paused during the pandemic under former mayor Bill de Blasio.
So de Blasio had halted the practice of using state test scores, attendance, and other so-called screens to determine admission, moving to a lottery system instead for middle schools. When that happened, I mean, I know a lot of parents who had kids here in New York City were like,
I just very briefly, an older sibling of a classmate of my son's, I talked to his dad when this happened. They got on the lottery system, and the kid literally pulled the worst number you can pull. And they had nowhere to go. They ended up sending the kid to private school and actually pulling from his college fund in order to do it.
wow, because they knew the choices, because the lottery was so low, weren't
got
going to
last
be
choice,
great. Weren't going to be great. The practice has been
And he's lucky, he knows he was lucky to be able to do that.
Yeah, right. Not everybody has that choice.
Yeah.
The practice has been decried by critics as a driver for inequality in the U.S.'s largest school system, with some parents and educators pressing to make the change permanent under the new administration of Mayor Eric Adams. Schools Chancellor David Banks met with dozens of groups to evaluate the process, but ultimately kept grades-based academic screens in place for high schools.
Banks, the process, as you mentioned, it's separate from the city's 8 specialized high schools, like the Bronx High School of Science and Stuyvesant High School. Those were unchanged and will still rely on the specialized high school admissions test, according to the announcement. It'll impact about a quarter of the city's 444 high schools, according to the Department of Education.
I should point out, New York City has the most segregated school district in the U.S. by race. Critics cite the screening process as a driver of inequality at the city's top schools, which tend to serve more white and Asian students, even though Black and Hispanic students represent the majority of the city's student body. I mean, this is what's at issue, right? Or one of the issues.
Yeah, I mean, it's funny. You don't think about education until you become a parent, but it's something you think about a lot when you become a parent.
Absolutely. It's not easy. Massive school system, and I guess they're trying to figure it out, but no easy solution. You're listening to Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We heard from Nike moments ago. The stock is bouncing around in the late session right now with a loss of about 1.6%. First quarter revenue came in above estimates at $12.69 billion. The street was looking for $12.31 billion. At first blush, it looks like sales for China were slightly above forecast. In the regular session, we had weakness in the equity market. That's the bad news if you're long stocks. The good news, we finished well off the worst levels of the session. S&P today down about 2.1%. We had a number of Fed officials stressing the need to keep raising rates to battle inflation. The head of the Cleveland Fed, Loretta Mester, was saying rates may need to go to a level a little above what her colleagues are expecting. Now, the day's economic news would support the idea of higher rates. The readings on second quarter core PCE and personal consumption were both stronger than forecast, and weekly jobless claims now at the lowest level since April. Dow Industrial Average down 1.5%, the S&P 500 weaker by 2.1%, and the NASDAQ comp dropping about 2.8% today. Apple down by nearly 5% today after Bank of America warned of weak consumer demand for iPhones and laptops. And Meta Platforms, the parent of Facebook, announcing a hiring freeze, and the company has warned employees of a restructuring aimed at cutting costs and shifting priorities. Meta shares today weaker by 3.7%. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Doug, thank you so much. Well, according to a report out late last year by Research Dive, the global digital educational publishing market predicted to garner a revenue of nearly about $28 billion by 2027, growing rapidly, a compound annual growth rate of 17% from 2020 to that 2027. So we're talking about some pretty rapid growth, and we have a great guest to talk about this industry.
Yeah, we've got Andy Bird with us, the CEO of Pearson, joining us right now in the Bloomberg Interactive Brokers studio. And we are talking a big publisher of textbooks here.
Also a radio anchor and producer,
yes.
we heard at some point.
And there was something that you did in between those two things that I think is of interest to a lot of people
a little
as
ditty,
well.
a little company known as Disney.
Yeah.
We'll get to that.
You can't say the House of Mouse, right?
Yes, you can.
Okay.
You just did.
All right, I just did. Andy, how are you?
I'm great. It's great to be here. And I started my career in radio a long time ago, painting pictures with words. It's the best medium.
Perfect.
So there's hope for us, Carol.
Or you may come join us. We might have 3 anchors going
That's
forward.
a good point. Hey, when we talk to CEOs, we want to dig into the nitty-gritty, but one place that I really want to start is just the macroeconomic landscape. I mean, you're joining us on a day where we've seen fresh lows this year for the S&P 500, tech just getting wrecked today. When you look out across the industry, across the U.S., across the world, what do you see?
I mean, very much what we're all seeing is it's very chaotic out there. I think there is a flight to quality. Certainly, we're seeing that. We're listed on the FTSE in London, and we were actually the best performing company for the first half of this year. And I think that's down to the resilience of what we do, not just necessarily the sector we're in, but the range of businesses we're in, and the resilience of our business. And I think, the days of free money being over, is starting to have an impact. I think,
Are those days over or just paused?
I'm not sure they're going to come back to the recent past very quickly. Okay. I'm not so certain. I mean, in many ways, the last decade or so, which we've all got used to, was somewhat abnormal if you look on a much longer time horizon. We all used to pay interest rates sort of around mortgage rates. I can remember paying mortgage rates that were very similar to what they were today.
Yeah.
But suddenly we got used to free money.
Yeah.
And I also see that about, we see this in terms of investor interest in Pearson, is like, oh, wow, you're a real company with real sales and real cash flow and real profits. Wow.
Well, Andy, talk about your business, right? Educational learning, like how, resilient is it to recessions? It's education. So how often, do you guys get hurt when the economy goes down?
We're actually counter-cyclical historically.
Okay.
As whether it's inflation, unemployment, people turn. You see college admissions go up, for example. The other thing about Pearson is that we're a lot more than educational textbook. I think what's unique about the business is and what attracted me to the business, and you referenced, Disney. In many ways, when I joined the board of Pearson before I became CEO.
Right.
And, it's this continuum from the creation of intellectual property, which we do. It used to be the form of a textbook. It's now digital. That's, I find, a very interesting area, all the way through assessment and ultimately to certification, verification. And we're seeing, the world move to, skills-based learning, this notion of how you redefine higher education.
Well, let's go there, because Tim and I have a lot of conversations, and even with heads of colleges or universities who are also thinking, like, I don't know if the 4-year program makes anymore, or former heads. And I do wonder, are you seeing signs increasingly where that model is kind of coming undone, or people are going and getting maybe an associate's or a couple of years, going to work, coming back, going for other certifications? What insight can you tell us about that?
I mean, we're currently in the back-to-school period, and we'll have enrollment data for this season in 4 or 5 weeks' time.
Yeah.
And so we'll have a better picture then. Certainly the last couple of years has seen declines in U.S. higher ed college enrollments. How much of that was cyclical or driven through by the pandemic? Right. How much of it is a permanent, I tend to think of it in the following ways that, when I graduated from high school, if I wanted to further my higher education, I only had one door to go through. That was university or college. Now there's two. There's enterprise learning and there's institutional learning. And I've said in the past, I think some of the biggest universities in the world arguably now are institutions. You look what Amazon's doing, for example, where if you're one of their 1 million workers in a fulfillment warehouse, Amazon will pay for your college education. And that, I think, also plays into this hybrid mix of 2-year versus 4-year, the role of community colleges in the mix. Same if you're a barista at Starbucks. This notion of an individual understanding the importance of learning and the way that now technology allows us to deliver learning, I think is going to have a profound impact. I think we're just at the start of quite frankly, a revolution.
Well, we're going to talk more about this, because when we talk about disruption and innovation, I think we've often had conversations that healthcare and education have really lagged, but it does feel like something's out there.
But what's the answer?
Well, I think you can do it better and hopefully cheaper. We're going to continue with Andy Bird. He's CEO at Pearson, lucky for us, in our Interactive Broker studio.
broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C., Bloomberg 99.1 to Boston, Bloomberg 106.1 to San Francisco, Bloomberg 960 to the country, Sirius XM Channel 119, and around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Businessweek.
All right, we are having a...
Too bad the mics weren't on, Carol. We just had the second part of the interview during the commercial break.
We're going to bring it all to you, though, live in just a moment. We're going to continue with Andy Bird, CEO of Pearson. He is in our Interactive Brokers studio talking about textbooks, education, and how things are being changed, innovated, transformed.
Yeah, what does that transformation look like? We're going to have more on that in just a few minutes. In the meantime, let's get over to Doug Krisner, because, Doug, there was a lot of red on the screen today.
There was indeed, but before I get to that, Tim, I want to talk about Nike, because we heard from the company after the bell, and the stock right now is weaker by about 3.8%. At first blush, these numbers look pretty good. Revenue beat estimates at $12.69 billion. Now, Greater China revenue was down 16%. That sounds like a big drop, but the actual number was better than forecast. And then if you look at first quarter EPS, 93 cents, that's a penny ahead of forecast. First quarter gross margin, 44.3%. So maybe, I'm guessing, maybe there was a little disappointment on that front. But to get back to the point that you made a moment ago, Tim, yes, a lot of weakness in the equity space today. Although the equity market did finish off session lows, we had the S&P down about 2.1%. Now, the day's economic news supported the idea that the economy can withstand rate hikes. Readings on second quarter core PCE and personal consumption, both of those numbers were stronger than forecast. Weekly jobless claims now at the lowest level since April. And on top of that, we had a number of Fed officials kind of stressing this idea that rates need to keep rising to fight inflation. And Cleveland Fed President Loretta Mester was saying rates may need to go to a level a little above what her colleagues are expecting. Right now, based on the last Fed meeting, I think the consensus view is that Fed funds would reach 4.4% by the end of the year. That's 125 basis points from where things are today. Dow Industrial Average down 1.5%. S&P 500, I mentioned, weaker by more than 2.1%. NASDAQ comp off 2.8% today. Weakness in Apple and Meta platforms. We'll talk more about that in 15 minutes. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Doug, thank you so much. I want to get right back to Andy Bird, who is CEO of Pearson, also former president of Walt Disney International. Then he was chairman of that division, 14 years at that company. He's still with us here in our Bloomberg Interactive Brokers studio. We want to talk more about what you're doing at Pearson, but we were just talking about Disney a little bit. How do you think about that company, the impact it's had on you, as how you think about what you want to do at Pearson? Talk to us a little bit about that time there.
It had a profound impact on my life, on my family's life. I moved from the UK to Los Angeles. I had the immense good fortune to work for Bob Iger for those 14 years and really be part of a transformation, which is very similar to what we're doing at Pearson from, back in end of 2003 when I joined Disney. And, Disney's stock was $12 something and change. People sometimes forget that. And, the journey from the acquisition of Pixar and Marvel to Lucas and beyond. When I joined the board of Pearson, I went, wow, there's so many similarities with this company and Disney, but whereas Disney's the world's leading entertainment company, Pearson can become the world's leading learning company. So we're in the business of education.
Right.
So let's keep the comparison going. If you look at the way that Disney transformed itself into a company that has really been a powerhouse over, the last decade, more so than at any other time, with theme parks and the acquisition of Lucasfilm and other companies that have done really well for it, and transition to streaming as well. How do you take what you learned at Disney and apply that at Pearson for its own transformation?
So at the heart of both companies is intellectual property. I think that is so powerful, and we content.
Right.
Content is so important, and so the heart of Pearson is intellectual property. It used to take the form of textbooks. It's now far more interactive. You use video, graphics, audio. Who are talking about the ways that you can ultimately, it'll go into virtual reality and the metaverse and beyond. The way that technology is allowing the delivery of learning experiences is radically changing. And at the heart of our company is, we have over 5,000 authors content creators. We have that learning ecosystem, and then you start to put that out with distribution, the ability for us now to go direct to a consumer. We launched Pearson Plus for US college students 12 months ago, and in 12 months got 4.5 million registered users. That's not many startups do that.
Right.
So it's many, many different parallels.
Well, what I'm hearing you talk about, and we were talking about this while we were in a commercial break. So you mentioned metaverse, and we had some news on Meta today, and it's going to be difficult as they transition to metaverse. It's not an easy transition. Not everybody's buying in. Investors certainly are. How do you think about things like the metaverse? How do you plan for it today when there's still so many questions? How do you think about things like NFTs? And that probably plays to content, right, and proprietary.
Yes. In a way, if you deconstruct the textbook, which you're able to do now, and think about learning modules rather than chapters of text, they can be pieces of audio, pieces of video, and if you mint each of those to ensure that the author of that, the creator of that content, and by placing on blockchain, gets paid appropriately throughout its life.
Do you need the blockchain to do that?
No, but the blockchain makes it a lot easier.
It does?
It's really, royalties are really complex.
So this actually simplifies the royalty process. Because I have yet to, I'll be honest with you, I've yet to hear a very compelling case for the blockchain. One that's
royalty
actually... See, and I get blockchain more than I get some other things.
Yeah, but I mean, this technology has been around for more than a dozen years. I mean, how has it actually made our lives better?
Well, I think it gets clouded rather by the whole crypto noise. But
he's a huge crypto guy.
Oh, okay. Underneath all of that.
I mean, I would say skeptic too. I'm very interested in it. Yeah.
But then if you think and you move forward and you think of learning and technology, virtual reality and everything like that, that plays right into learning.
But you can't make bets today on like the metaverse.
Oh, but you can be curious.
Okay. But you run a publicly held company. How curious can you be?
We can be very curious. Okay. We have a whole team, and all they're doing. I participated in an in-house innovation. We had 8 entries from across the company around applications for the metaverse, and we're going to take some of those forward.
All right. I cannot believe that we've run through our time. I'm like blown away. We've got 30 seconds left here. I'm going to get yelled at if I don't ask you this question. And I know you were with our editorial board team and talking about things. Apollo Global, 3 offers. You guys said turn them down. Are you going to stay independent? What are you going to do, real quickly?
Very quickly. I mean, yes, we did. It was all very public. They offered £8.70. I think our stock is trading at around £8.70 if you look in pound sterling, given everything else that's going on. And I think, if anything, their approach validated our strategy and validated the great prospects that this company has.
But the right price, maybe?
No?
I'm very happy doing what we're doing. I focus on delivering results and exceeding expectations.
Well, this was fun. Come back, continue to have a conversation with us about what you are doing, because the educational space, as we've said, innovation, so much to be done. Annie Bird, thank you so much. Really appreciate it.
Thank you both.
Chief Executive Officer at Pearson, and might be a third anchor for us coming.
Depends on what happens with Apollo, maybe.
He's shaking his head now.
Let's get to World and National News with Nancy Lyons, D.C. Hey, Nance.
Thanks, Tim. Florida Governor Ron DeSantis says crews are trying to reach those who were stranded by the floodwaters of Hurricane Ian. It hit land yesterday near Fort Myers as a Category 4 hurricane and has been downgraded now to a tropical storm. DeSantis says they are now trying to determine the most pressing needs.
We're surveying the damage right now. Some people that evacuated, they're going to go back and look at their homes and see, is there flood damage? Is there wind damage? Is it going to be habitable? And so all those things, as those happen, we're going to get a clearer picture of some of the unique needs that individuals in this region may have.
Governor DeSantis spoke with President Biden by phone earlier today. Biden has formally issued a disaster declaration, and FEMA Administrator Deanne Criswell is expected to visit Florida tomorrow. The newest Supreme Court justice is getting some high-profile support as she prepares to take the bench next week.
President Biden, Vice President Harris, and their spouses will all attend the invitation-only investiture ceremony tomorrow for Justice Ketanji Brown Jackson. It is a sign of the importance the White House places on installing the first black woman to the High Court. Besides Justice Jackson, the White House says 68% of President Biden's 143 judicial nominees have been women. 66% are people of color. The new Supreme Court term begins on Monday. In Washington, I'm Nathan Hager, Bloomberg Radio.
Conservative activist Ginny Thomas, the wife of Supreme Court Justice Clarence Thomas, talked today with the House panel investigating the January 6th insurrection. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy Lyons, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. Carol Massar along with Tim Stenovic live in our Bloomberg Interactive Brokers studio. So, interesting story by our Ben Bain of Bloomberg News. Wall Street banking giants, including Goldman Sachs, J.P. Morgan Chase, and Morgan Stanley, are set to take part in a new Federal Reserve program to measure how extreme weather impacts portfolios and business strategies.
I mean, there can't be a more
took them?
important time to talk about this as we watch what's happening to our fellow Americans who are in Florida right now being impacted by Hurricane Ian. I mean, the images, and you've heard it from Nancy throughout the program today, absolutely just harrowing coming out of there. But back to Ben Bain's story here, Carol, the pilot climate scenario analysis exercise. That's what it's called. It's a mouthful.
Yep.
It's
no acronym, right?
Not yet. They'll figure one out.
Yeah.
It'll take place during 2023. It marks one of the most concrete steps by bank watchdogs during the Biden administration to address risks that a changing climate pose to the financial system. In a stark reminder of the damages that severe storms can cause, more than 2.6 million Florida homes and businesses right now are without power on Thursday after Hurricane Ian ripped through the state.
Yeah, the Fed said that the program meant to assess the resilience of the firms under hypothetical situations. This is what the Fed often does. It won't have any capital or supervisory implications for the firms. According to the Fed, Bank of America, Citi, and Wells Fargo will also take part. But this gets to material financial impact or concerns about the financial system and where are the risks? And I feel like when you go back years ago when ESG started when we started, that's what was the focus, right? Like, what was the financial impact of climate change?
But what has it done now? ESG.
Well, we know.
How has the focus shifted? Or how has the umbrella gotten so big that it's essentially being used as a catch-all phrase for kind of companies that people want to position as ones to invest in?
It's gotten a little messy and a little muddy.
Very messy.
And this is specifically for the big banks, right? Because we know during the financial crisis what can happen when their risks are overheated. Great story. Check it out at Bloomberg.com.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Down day for the equity market indeed. I'll have more on that momentarily. We heard from Nike after the bell. Gross margins at 44.3% were a little disappointing. The street was looking for 45.4%, so the stock right now is down about not quite 5%. Revenue beat, earnings a penny ahead of estimates, and the numbers coming out of China, even though revenue in China was down 16%, the final figure topped forecast. But as I mentioned earlier, we had the weakness in the equity market today. A number of Fed officials stressed the need to keep raising rates. Cleveland Fed President Loretta Mester, she said rates may need to go to a level a little above what her colleagues are expecting. Right now, the forecast, I think the consensus view among the Fed is that we'll be at a Fed funds rate by the end of the year around 4.4%. Shares in Apple today fell nearly 5%. That was after Bank of America warned of weak consumer demand for iPhones and laptops. And Meta Platforms announcing a hiring freeze, and the company warned employees of a restructuring aimed at cutting cost and shifting priorities. Meta shares today off nearly 3.7%. So the Dow drops 1.5%. The S&P comes in by about 2.1%. NASDAQ comp weaker by 2.8%. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Doug, thank you so much. We often talked about this data from our Bloomberg intelligence team about how ESG may surpass $41 trillion in assets in 2022, not without challenges. And Tim, we know most notable is the continued heightened scrutiny as regulators tackle the risk of greenwashing and some other issues.
We've got a great guest on this. Kisa Shreen is Global Partner Director of the London Stock Exchange Group. She's with us right now in the Bloomberg Interactive Broker Studio. She's also got the new book out, Gambling on Green, Uncovering the Balance Among Revenues, Reputations, and ESG. She's also part of Ceres, which is a nonprofit sustainability advocacy organization that's been around for quite a lot of time before we were even talking about ESG. So ESG is on everyone's radar at this point, Kisa. But as Carol and I have been talking about throughout the program and really over the last few months, under increased scrutiny right now, thanks to a lot of what's happening in Europe. What do investors need to understand about how to read through the noise when it comes to ESG?
Absolutely, and great to be here, Tim and Carol. The first thing we really need to think through is the types of ESG investing that we're talking about. You could be looking at values or value investing. I'll break that down a bit. So there is ESG integration, which is when an investor takes their typical standard stock selection model and they just apply ESG or sustainability factors to it. Then on the other side of the spectrum, there's impact investing. And I suspect that when people hear ESG investing,
they're two very
different things. Think about a spectrum, and they're on either end.
Tell us about the difference between the two.
Sure. So ESG integration, you have your typical traditional stock selection process that the investment manager takes, and they apply sustainability factors onto that. Then the impact model, which is impact investing, which is really looking for a positive social or environmental outcome. Two separate things. One is focusing on that positive environmental or social outcome, and the other is just typical traditional investing with ESG sustainability factors integrated.
Can both provide returns, or more importantly, can impact? Right? Because that's, I feel like, smarter. Can I say that? Because I do feel like ESG is going through a reckoning. So much money has come in. There's not a really clear way of measuring. And the ESG, umbrella, different ways to measure each of those metrics, some easier than others. Impact, though, is very specific, right, in its intention.
Impact
is intentional, I feel like.
It is intentional. It's very specific. And I think that's where a lot of the confusion lies, honestly. I think we hear ESG investing, we think impact, but not all types of ESG investing are impact.
Okay.
So what should
we?
Go.
Okay.
You go.
So I'm just trying to think about how to phrase this. So it's all well and good to talk ESG and investing in what you believe in a market that just seems to continue to go up, up, and up. But people are running for the hills right now. And with the NASDAQ that's down more than 30% this year, S&P 500 down more than 23%, are investors caring about ESG still?
So let me break it down like this, Tim. Are investors caring about risk still? The answer is going to be yes, right? ESG is simply about, part of it is simply about risks. And let me give an example. If we talk about our investment in a piece of real estate, we can say what the investment is today, what it's going to be like in 10 years, but in 15 years, what we see may be totally different than what we're seeing now. Physical climate risk is a risk, and it's real. What's going on with hurricanes, tsunamis, those things are happening and more. They're getting more and more prevalent. And so when you have investments in certain locations, you need to be mindful of how things are going to change from a physical perspective. So to answer your question, yeah, it's something we need to think about right now because we see these climate issues taking place right now.
So I want to get back to, I think, and this is where part of the reckoning is that how do we measure it? Because what we're finding is that a lot of ESG investments that we would just don't sound like that they should be part of the ESG umbrella. We hear that about big oil or so forth, or that Tesla's not part of an ESG index for whatever reasons. So how do we what is ESG, or do we have to redefine it? You have a lot of clients, you work with them. So how do you guide them, or what are they? How can we do this better?
Sure. Well, I've spoken with dozens of investors, and they say, you know what, ESG, environmental, social, and governance, those are three different things. You have governance. That's about ethics of the corporation. You have social. That could be what's going on inside the company or even outside. And then you have environment, which we consider climate in many cases. So first of all, we need to think about how those things are interrelated. And I love talking about the story of what we saw with the pandemic, right? During the pandemic, we heard a lot about these underlying health issues. Well, if we trace this back and look at who had to live in certain locations that may have been near industries that were pumping things into water or pumping things into the air, and we had to drink the water and breathe the air, we see many underserved communities as a result of redlining, which is it's a practice now that we should not be doing, but it was legal back in the day. And we see that people are forced to live in these areas. So they developed illnesses, and they had these underlying conditions that were then, really made major during the pandemic. So those are the sorts of things when we talk about how climate is related to social, and then the ethics part. Well, what can companies do to make sure that doesn't happen, that the water that they use, that they manage it well, that they recycle and reuse well? That's how the governance piece plays. So first of all, we need to look at them and see really how the interrelationship works.
Right.
And then from there, you talk about measurement. As you can see, with climate, there is a lot of conversation about standards, and those things are being measured. With social, it's not that easy. I was talking with Michael Posner, who was U.S. Assistant Secretary under President Obama, and he was talking about just the variety of social pieces and just how there's really no way to measure worker engagement along with what's going on with your consumers and how your consumers are using your product. Is the product safe for them? How can you put all of that into one bucket? And it's very challenging.
Well, though, I would go back to one of the things I like to put out there, until a company is penalized for not hitting ESG metrics in some way, so what? We talk about earnings all the time. So we look at top and bottom line, we look at margins, and unless there's an ESG metric where you are financially going to be penalized, so what? Because ultimately it's going to come down to performance, like in a stock. Do you know what I mean? Like, so do we have to get to that point where there's some kind of measurement that when a company reports, you're going to be rewarded by investors or not if you don't do well?
So when we talk about measurement, there are a couple of different things we can look at. We can
only get about 30 seconds.
Okay. Regulators as well as consumers. Regulators really want to be able to make sure that the things that are important to consumers and the things that should be legalized, that things are carried through. Consumers